working abroad. We have what we call the expatriate employees working in Kenya. We have sportsmen or professionals, sportsmen and entertainers that basically earn income from abroad. Then we have businesses that are carried partly in Kenya and partly outside Kenya. So then we get to what we call the objectives of double taxation agreements. What we call the objectives of what we call double taxation agreements. Objectives of what we call the double taxation agreements. So what we call the objectives of what we call the double taxation agreement. So what do you think are the objectives of what we call double taxation agreements, where two countries engage into an agreement for citizens probably working in those two particular countries? One of which is basically to attract investment. We say to attract investment. So basically, when you're taxed on both ends, will that be able to attract investment? Let's say, for example, there is the two countries, for example, Kenya and let's say China, and we do not have double taxation agreements. What happens? It basically implies that you're going to be taxed double. And in that scenario, do you think we'll be able to attract what we call investment? We will not be able to attract investment. So we say to attract what we call skilled manpower, to attract what we call skilled manpower, to basically attract what we call the skilled manpower as a second, to attract what we call the skilled manpower, then to protect citizens of the country, protect what we call citizens, we say of a country, we say from what we call from double taxation, to basically protect citizens of the country from what we call the double taxation, to protect what we call the citizens of the country, we say from double taxation. We can also say to facilitate, we say to facilitate what we call free movement, we say of labor, to facilitate what we call free movement of labor. In instances where an individual is taxed double, in cases where countries do not have what we call the double taxation agreement, people will not easily move altogether. Then say encourage citizens of the country, encourage what we call citizens, say of a country to look for jobs, for jobs abroad. So this definitely will encourage what they call the citizens of a country to basically look for jobs abroad because of these agreements. Together, team. If you're together, then you just give it a yes. If we are together, then we give it a yes. So what are some of the countries, VMM, switch off the video. What are the countries, some of the countries that Kenya basically have what we call a double taxation agreement with? What are some of the countries that Kenya basically have what we call the double taxation agreement? What are some of the countries that basically Kenya has what we call a double taxation agreement? For sure, United Kingdom, Kenya has what we call a double taxation agreement. We have India. We have what we call the East African Community, that is Uganda, Tanzania, Burundi, and Southern Sudan. We also have Sweden. These are some of the countries that basically Kenya has what we call a double taxation agreement. And the essence of those agreements, we talked about the objectives of those agreements on this particular. So I want to talk about what we call conditions to be met. Conditions to be met we say to be met, we say in order to qualify, in order to basically qualify for what we call for double taxation relief. So we have what we call conditions to be met in order to qualify for what we call the double taxation relief. Then in order to qualify for double taxation relief, there are certain conditions that must basically be the certain conditions that we understand that must basically be met in order to qualify. What are these conditions that basically must be met in order to qualify for what we call double taxation relief? What are these conditions that must be met? So in order to qualify, tax must have been paid in other countries altogether. If you're Kenyan, the tax must have been paid in other countries. So the first one, we say the tax must have, we say, been paid. The tax must have been paid in that, we call it other country. The tax must have been paid in that other country on income. On income, we say subjected to what we call to double taxation. On that income that are basically subjected to double taxation, that the tax must have been paid to that other country, basically on that income that we understand is subjected to double taxation. Number two condition will basically say that double taxation relief, double taxation relief, we say should not exceed. So what we call the double taxation relief should not exceed what we call the tax payable in what we call in the home country. In the home country. But the double taxation relief should not exceed tax paid in the home country on income subjected to double taxation, on the income that we understand is subjected to double taxation. In most of the questions, you'll always find that the tax on other countries is lower, are we together? As compared to the same income subjected to taxation in Kenya. Together, team, we respond with a yes, if you're together. Are we together? So the third, there must be what you call the double taxation relief policy. There must be double taxation. There must be what you call the double taxation relief policies, say in the country. There must be what you call double taxation relief policy in the country. There must be what you call the double taxation relief policy, and we understand in the country. Then we say we have four that we call time limit. Time limit. Number four, we understand the time limit of making the claim, of making what you call the claim, of making claim. We say for a relief, time limit for making a claim of relief. We understand 6 years since the tax payable in what you call was payable in that other country, was payable in that other country. in relation to income, in relation was 6 years since the tax payable was paid in other country. In relation, we say in relation to double taxation. In relation to what we call double taxation. In relation to what's called the double taxation. Those are conditions in order for one to qualify for what we call the double taxation relief. We respond with a yes. Together. We respond with a yes if you're together on those conditions. We give it a yes if we are together. 𝐎𝐿𝐶𝐒, are we together? I'll say it on those conditions in order for one to qualify for double taxation relief. The tax must have been paid in that other country on income subjected to double taxation. There must be double taxation relief policy. And we basically said that the double taxation should not exceed the tax payable in the home country subjected to what we call the double taxation. So we get to what we call areas covered by double taxation agreement. Areas, we say covered by what we call double taxation. Areas that are basically covered by the double taxation agreements. Areas that we understand are basically covered by the double taxation agreement. And so one of the areas we basically say persons covered by the agreement. We understand the next is taxes covered by the agreement. Incomes that are affected by what we call the agreement. We have what we call terminations of agreement. Are we together? Terminations of agreement. So we can what we call one is persons covered by agreements. Persons that we know are covered by agreements. Number two, taxes. We understand covered by what we call agreements. Taxes are basically covered by agreement. Then number three, we have what we call incomes. Incomes, we understand affected by what we call the agreements. Incomes that we understand are affected by the agreement. You also have another area what we call terminations. Terminations of what we call agreements. Terminations of agreements. So then we have aspects of determination of residence of a taxpayer. Aspects of determining what we call residency of a taxpayer. Together, we respond with a yes, basically on areas that are basically covered by double taxation. Together, team. FJ, Lenovo, Mary, and the rest of the class. Tuko pamoja. If you're together, then we respond with a yes. So then if you're together, then give me a yes. So then we go to forms of double taxation relief agreements. What we call forms of what we call double taxation agreements. Forms of what we call the double taxation agreements. What we call the forms of double taxation agreement. One of the first form, we have it as unilateral. We have the first form, what we call unilateral relief. So when you say unilateral relief, what do you basically mean? Unilateral, before we get to bilateral, what do you basically mean by unilateral relief? Unilateral relief. I hope Miriam is in class. I hope Miriam is in class. And I hope Chengo is also in class. Perfect. And I hope Chengo is also in class. Yes, perfect. And I hope Gilbert is also in class. I hope Gilbert. Elvis is also in class. I hope Elvis is also in class. Perfect. Our representative, Sheila, I hope she's also in. So when you talk about unilateral relief, what do you basically mean by unilateral relief? Unilateral relief. When you say unilateral relief, we say this is where we say that the government, this is where the government, we say that this is where the government decide to grant, decide to grant what you call relief, decide to basically grant relief to its citizens, working abroad, decides to grant relief to its citizens working abroad who are subjected, we say who are subjected to what we call double taxation, who are basically subjected to what's called double taxation without considering. Unilateral touches on one aspect. We say without considering. We understand that without considering whether other governments grant what they call their citizens, working in the country, double tax relief. And that is simple. What are we trying to say? That when you talk about unilateral, you basically grant to your citizens working abroad, you grant them relief without considering that the expatriates are granted relief by their countries altogether. That is basically what's called unilateral relief. Together, we respond with a yes. We respond with a yes if we're together. So then we go to bilateral. What they call the bilateral reliefs. So what is bilateral relief? What they call the bilateral relief. So what is the bilateral relief? What is a bilateral relief? When you say bilateral relief, what do you basically mean by the word bilateral relief? Somebody try. If we understand this, then this should be simple. So who can give us this? If you understand the unilateral, then bilateral should be very simple. So what is bilateral? So bilateral, countries basically considered. Bi means two, not more. Bi basically means two countries. Mary, when you talk about bi, basically means two countries. Are we together? They are in agreement. Not only one country is in agreement to grant its citizens, both parties are basically involved. And that is to say, this is where, this is where we say two, this is where two or more countries, but specifically by should be two or more countries negotiate, and say conclude, negotiate and conclude what they call the double tax relief, negotiates and concludes what's called the double tax relief, the double tax relief agreement, double tax relief agreements to say where the citizens, where we say the citizens, where the citizens working in these countries, working in these countries are granted what they call the double taxation relief, where citizens working in these countries are basically granted relief. So they say, basically say, even when you say more countries, so more countries, we could have Kenya, and maybe China, we can have Uganda and Kenya, but they're coming in agreements together, where those personnel from the country working in both countries are basically granted what they call the double taxation relief. On the unilateral, what you say that if we are talking about unilateral, we grant this relief to personnel, basically Kenyans working abroad, but you don't consider whether those other countries are providing relief to their people together. So we go to the methods of determining double taxation relief. So we go to the methods. We call it methods of what we call of determining what we call the double taxation relief. So methods of determining what we call the double taxation relief. What are the methods that we basically have to determine what we call the double taxation relief? So there are basically two methods. We have the exemptions method, and then we have what we call the credit method. So we have number one, we call it exemption. We call it the exemption method. And number two, we call it the credit. We call it the credit method. So we have what we call the exemption method, and then we have what we call the credit method. So we have what we call the exemption method, and we basically have what we call the exemption method. We have what we call the credit method, and then we have what we call the exemption method. I want to start with the exemption method. To exempt, what does it mean to exempt? To exempt, what is exemption? When you say to exempt, not charge tax, perfect, Mary. So we have the first method, and we're calling it exemption. We are calling it the exemption method. We are basically calling it the exemption method. So the first method, we call it the exemption method. So we're saying in this, we say income. In this, we basically say that the income, and this the income, in this the income, say and abroad, and we say affected, and affected by what is called by the double taxation, and affected by what is called the double taxation, we say is not subjected to what we call tax. So basically, we're saying that the income that is earned abroad and affected by what we call the double taxation, the country will not basically now subject it to tax in the home country, to tax in what we call the home country. Will not subject it to tax in the home country, as long as, we say, as long as the tax was paid in what you call in the source, as long as the tax was paid in the source country, as paid as long as the tax was paid in the source country, as long as the tax was paid. So say a country, source country is country where the income we say was generated. So source country is the country where the income was basically generated. The source country is basically the country where the income was generated, where the income was basically generated together, where the income was generated. All of us are together. I want to pose a question. If you're together. Perfect, if you're there. So the question is altogether. I believe there's much closure in terms of now you understand what happens altogether. What happens if you have maybe family members abroad, are we together? When you have family members abroad, are we together? When you have what you call a family members abroad, are we together? I'm moving. When you have what you call family members abroad, are we together? And the questions pertaining to what you call tax, how do you go about it together? In cases where there have been, how would you go about it practically? In case, for example, we have what you call an exemption clause altogether, but they have a PIN. What are you going to do? When you look at two countries, you have what you call an exemption clause. What are you going to do in scenarios where we have what you call an exemption clause? But they still have a PIN. So that PIN, what are you going to file on that PIN? On that PIN, there's not an income that was generated in Kenya. The whole of their income was basically generated abroad, but we have in scenarios where we have exemption clause. With that PIN, what are you supposed to do with that PIN in terms of now filing taxes? So what are you going to do to that PIN? That is the question. What are you going to do to that PIN? We respond with a yes. What are you basically going to do with that PIN? Kindly, what are we going to do with that PIN? So basically, it's say exemptions altogether. Exemption is basically exemption. You ask for a refund. You ask for a refund. Why should you be refunded? And we have what we call exemption clause. I want to expound on the exemption clause. We are basically saying that as long as you are paid, you are a citizen. Yes. Yes, perfect. With supporting exemption certificates together, with supporting exemption certificates together. In that case, what are you going to file? What are you going to file? I know practically there are a few areas of application and a number of things. Practically, not many people make this disclosure. Is that true? Practically, not many people make this disclosure. Is it true? When it gets to this area, how do you find, for example, for those brothers who are not here? Yes, they definitely file nil altogether. But again, you need to provide maybe along the way, you need to provide those supporting documents altogether, especially when we have what we call exemptions altogether. Those supporting documents implying that there's what you call exemptions between those two countries. Then you have what you call the credit method. The credit method, we have what you call the credit method. So on the credit method, this is where a majority of the questions basically come. When you have the credit method, this is where a majority of the question comes. So we say in this case, we say that the tax paid, basically in this case, the tax paid in that other country, the tax that is basically paid in that other country. So what we call the source country, stroke the source country, stroke the source country, on income, subjected, on income, we understand subjected to double taxation, on income that is basically subjected to double taxation, on income that we understand is subjected to double taxation, is granted, we'll say is granted as relief, in relation to tax payable, on relation to tax payable in what call in the home country, we say on income, subject to what we call double taxation, taxation. So I just want to remind us on something. We say conditions that have to be met. What did I say about condition 2? Conditions that must be met in order to be granted what we call the double taxation. In order to be granted what we call double taxation. I think it was condition 2. That was condition 2. What did I say on that condition 2? That the tax that you're basically paying abroad should be less than the tax that you're paying in the home country. Are we together? So that tax that you're paying in the source country, you are basically granted. It is always what you call the lower. It is always what you call the law. Together, team. That's why you say that the tax that you basically paid abroad will be granted as what you call relief. It will be granted as a tax credit. We'll respond with a yes if you're together. Will be granted as a relief. Basically, with our condition number 2. Basically, condition number 2. We'll respond with a yes if it's here. Subject to condition 2. Perfect. So I want to ask to determination. Now then we get to question, determination. We'll call it determination. Determination of tax, what we call determination of what we call tax of double tax, what we call the double tax relief, determination of what we call the double tax relief in Kenya, determination of what we call the double tax relief in Kenya, and what we call determination of what we call actual tax, of what we call actual tax payable, and what we call the actual tax payable by what we call persons, we say affected by persons that we say are affected by what we call by double taxation. We understand those persons that are affected. Are we together? Do we understand on those persons that are basically affected by what we call the double taxation? Persons that we say are affected by what we call the double taxation. We know the persons that are affected by the double taxation together. Is there a question on those who are affected by double taxation? Or that was exhausted perfectly well? Was that exhausted perfectly well? On persons that we understand are affected by what's called the double taxation. Perfect. So how do we determine, based now on the credit method, double taxation relief and the actual tax payable on the persons that are affected by what we call the double taxation relief. Number one, the double taxation relief is comparison. The tax that was basically paid on the source country, that is basically income that was earned abroad. Then you put that income in terms of the Kenyan system and you get the tax that is payable. Are we together? You get the tax that is payable. Remember, under the intermediate, we basically say that for resident, their employment or for business that are partly operated in Kenya and partly operated outside Kenya, we say that both incomes are basically taxed in Kenya. And the big question is that, is this now double taxation? And how do we sort those issues? Does this basically provide solution to those issues that we talked about on intermediate? Does it provide solution? If you remember, for those that I taught on the intermediate, does this provide solutions to those? Does that provide solution to that? Because the question is, if you say that you'll be taxed here and taxed that on the other side, what if you're taxed on the other side? How do we go about it? Which can? But first, on that determination of the of double taxation relief, we understand that the double taxation relief is basically the tax that was paid on the source country. That is the tax that is paid in abroad, which in our case, we understand that if you subject that income that was earned abroad in terms of taxation in Kenya, the tax that is paid in Kenya should be higher. Because the tax that was paid outside the country should be lower on the condition. Then how now do we determine the tax payable for these persons that are affected by the double taxation relief? So we understand that the double taxation relief, once we get it, we compare the tax that was basically paid abroad and the tax that was paid in Kenya. And we understand that the tax that is basically paid abroad is lower. We are going to use that tax that was paid abroad as what we call the tax credits. Together, team, we are going to use it as the tax credit. You give me a yes if we are together. You give me a yes if we are together. You give me a yes if we are together. And we basically said on these classes that the most important thing is to understand the concept. It's not a question. The most important thing is the concept behind what you're about to do. Are we together? So once we get the concept is the most important thing that we need to focus on. Once we get the concept right, we don't have to be perfect. We can go step by step. You can miss one step altogether. Prayer break. Can we take it now, or we give Aziz, you can allow us to finish this? Or class, are we in agreement that we take a break? Are we in agreement that all of us will take a break? Can we? So Aziz, you okay? You'll get us back. We also don't want to leave Aziz. So what we do, we grant the break to, with respect, it's time for prayer, and then we come back. So we give our 10 minutes. When you come by 7:01, yes, it's okay. Ouko, you're making the class lively. It's okay. So we can take our break so that we also respect it's time for prayer. The double tax relief is basically the law. One is tax payable. We call it tax payable. We say in Kenya, tax payable in Kenya on income. We say subject on incomes that we basically say subject to double, subject to what we call double taxation on incomes that we understand are basically subject to what we call the double taxation on incomes that we say are subject to double taxation. So you compare with the tax on what we call on the source country, tax on basically what we call the source country. We say on income, we'll say subject to what we call double taxation on income that we understand as subject to what we call double taxation together. So which on the condition, we basically know that the relief will be the tax that is from the source. So we say the steps in determining, we say in determining what we call the double taxation, steps in determining what we call the double taxation relief, and what we say and what we call the actual tax payable. So the steps that we use to determine the double taxation relief and actual tax payable by the taxpayer. And the actual tax, we say payable by the taxpayer. And the actual tax that we understand is payable. So I want us to be very keen on those steps. I want us to be very keen on these steps. I want us to be very keen on these steps. I want us to be very keen on these steps. So look at those steps. I want us to try and finish those steps by, in the next 10 minutes, we finish those steps. So the first step, number one step, we say that determine the taxable employment. Determine what we call the taxable employment. Income, we say earned in Kenya. That is number one, determine what we call the taxable employment income earned in Kenya. So number two, we say determine what we call total tax payable, on income. That is what we call the employment plus what we call the investment plus the investment income. So we have the employment plus what we call the investment income, employment plus what we call the investment income. Together, team, employment plus the investment income. So then with determination of tax payable, number three, we call it determination of what we call tax payable to income of tax payable. We say earned in Kenya, and Kenya. So determination of tax payable of income. This one was basically in Kenya. We also include what we call the income earned out. We also include what we call the income earned outside Kenya. Together, team, income that is earned outside Kenya. We respond with a yes if you're together. So income that is earned in Kenya plus income that is basically earned outside Kenya. Together, income that we know is earned in Kenya. Together, income that we know is earned in Kenya, and income that is earned, all of us tuko pamoja. Number two, you include employment plus. We also include now the income that is earned outside Kenya. We also include now the income that is earned outside Kenya. Together, Robert, Norbert, and Gilbert Nitish. Together, if you're together, we respond with a yes. So we have number, this was taxable income, so taxable income. This was determination of taxable income earned in Kenya and income earned in Kenya and outside Kenya. Number 2, determination of tax payable on income earned in Kenya and outside Kenya. Then number four, we say that determination of total tax, we say determination of what we call of total tax on what we call on total income, total tax on what we call total income, and in Kenya, and in Kenya, and in Kenya. So this is the taxable income, but now you determine the tax altogether. This is the taxable income. Remember, this is taxable. That's why I changed taxable income. After taxable income, you determine what you call the total tax on income earned in Kenya, and what you call outside Kenya, on income earned in Kenya, and that is earned outside Kenya. So say that is determination of total tax on total income. Determination of what we call total tax, we'll say on total tax on what we call on total income. So after determining what we call the taxable income, that is both in Kenya and outside Kenya, so you determine the tax that is payable on the total income. Then 5, determination, we get determination, we say determination of tax income, and in Kenya, determination of what we call the tax income and in Kenya. So I want to ask a question. The difference between this and this, what does it give us? The difference between number 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? So 4, we basically say that is the tax payable for income that is basically paid for income earned in Kenya. Yes, it's the tax on income abroad altogether, or the relief altogether. So that is the tax that is charged on abroad, which is the relief. That is the tax that is charged abroad, or what you call the relief altogether. So that determination. Then 6, we say this. We say it determination. We say determination of tax, we say on income. Determination of what's called tax on income. And outside Kenya. Are we together? Outside Kenya. The determination of tax on income outside Kenya. So tax on income, we say, and outside Kenya. Tax on the income and outside Kenya is basically equals to what we call tax on what we call total income. Tax on what we call total income. And we say in Kenya, and what we call outside Kenya. So tax on income and in Kenya and outside Kenya, minus what we call tax on income, we say, and in Kenya. And that is basically difference. We understand difference between 4 and 5. So that is the difference between 4 and 5 together. So the difference between 4 and 5 gives us the tax on income earned outside Kenya, which is the relief. Huko tuko pamoja. So that is the difference between point 4 and 5 together. And that is what we basically call the relief. Chengo tuko pamoja, Lenovo. If you're together, you give me a yes. If we are together, you give me a yes. Kindly. I hope we are together. Perfect, Chengo. We are about to be done. Then we pick a question. Thank you, Lenovo. Then 7, we say that we call it determination. Determination of what we call of double taxation. We call it relief. The determination of what we call the double taxation relief. Determination of the double taxation relief. Determination of the double taxation relief, which is taken, which we say is taken, we say as the lower, which is taken as the lower of. So you compare two things, which is basically taken as the lower of. Tax paid on source country, tax paid on what you call on the source country, on income. On income, we understand that subjected to double taxation. So say tax on income on the source country, tax paid on source country, on the income subjected to double taxation, on the income subjected to double taxation. Then B or 2, we call it tax payable. What do you call the tax payable? In Kenya, tax payable in Kenya on income. On income, we understand subjected to what you call double taxation. And we always understand that it should be the law because on the condition, if you compare the tax that is paid on the source country and the one that is paid in Kenya, this one is always the law, and that is what you call the relief altogether. Then say 8, that is 8, we call it determination of actual tax. We call it actual tax payable. Determination of what we call the actual tax payable. Determination of what we call the actual tax payable. Determination. We call it determination of what we call the actual tax payable, of the actual tax payable in Kenya. Determination of the actual tax payable in Kenya is, we say determined as follows. Is basically determined as follows. So say actual tax payable in Kenya. So the actual tax payable in Kenya is usually equals to, that is the tax on what we call on total income. The tax on total income. Total income is from abroad and Kenya. That is from abroad in Kenya. That is basically from abroad in Kenya, minus what we call the tax credits. Minus what we call the tax credits. Minus the tax credits. Minus the tax credit. And I open the brackets just to get those tax credits as I open the bracket. One of the tax credits is pay as you earn. We have insurance relief. insurance relief. We have personal relief, and what's called double taxation relief, and what's called the double taxation relief. So again, that tax, if you compare the tax that is paid on income from abroad, the tax that is paid in Kenya, and the tax that is paid from the source country, we say the law, which is basically the tax that is paid from the source country, we need to less it. So that we introduce another tax credit, which is called the double taxation relief. Is that understood as we pick on a question? I want us to pick on a question. Is there any question before I get to, before we start on actual testing on that? Is that understood? Tumeelewana? Tuko sawa? Are we together? Perfect. Chengo tuko sawa? VMM tuko sawa? Tax credit. No, I'm saying, Aziz, why do you say pay is not a tax credit or a setup? Why do you say it's not a tax credit? Why do you say it's not? Why do you say the tax pay is not a tax credit? Yes, on individual. Say on individual. Are we together? So we basically, when you say on individual, we understand that as a tax credit. Most of these questions basically touch on individual. As is most questions, particularly on taxation across the borders, most questions are formulated for individual. That's why we include it there. Is that noted as is? So I want us to pick the question. I think the question that was the last time that was in December. Check December question 5. Is Ambucha in class today? The last time, the latest was set in December 2024. Check for me December 2024, question 5. December 2024, question 5. Check December 2024, question 5. Companies who can have installment tax. Okay, installment tax. Installment tax. Okay, companies installment tax. They basically have the installment tax. Perfect. So I've said December 2024. If you look at the latest question, I normally start with those questions. Latest question. Do you have that question in question 5C? Nemeshukuru, thank you so much. So all of us, let's get that question 5. All of us, let's get that question 5. All of us, we get that question 5. Question 5, we say C. Yes, question 5C. So we call it deck 2024, question 5C. Kama tuko hapo tubonyeze yes. If we are there, then we respond with a yes. If we are there, then we respond with a yes. Allow me to open that question. submit it. So we are being told, Tamala Nyambura is a resident of Kenya, and you're being told that during the year ended 31st December 2023, she received the following income. She received what is called the following income. So number one is from employment in Kenya. The figure was 720. Then we have from employment in Zambia. The figure was shillings. The figure was shillings. The figure was shillings. We have it as shillings by 40. When you say net of 78 paid as tax, net of 78 that was basically paid as tax. So net, what does it mean when you say net? When you say net, what does it basically mean? When you say net, what does it mean? You add to get the gross profit as is. Assume that Kenya, you're told that assume that Kenya has what call, assume that Kenya has double taxation agreement with Zambia. And then you say that the income from Zambia has already been converted into Kenya shillings. So the figure that we're given is already converted. Some questions are we together? Some questions there's no conversion. But for this particular question, the income is already converted. And this question is very small, very, very small. However, it's a good one to kickstart. Is that okay, Aziz? It's a small question, but it's a very good one to kickstart. So then you're being told required, compute what's called the double taxation relief due to Tamala, the double taxation relief due to Tamala, and the net tax payable, if any, and the net tax payable, if any, for the year ended 31st December 2023, and the net tax payable, if any, for the year ended December 2023. We can use our procedure. Are we together? We can use, so we can have it Tamala Nyambura, Tamala, we call it Nyambura. Taxable income, we call it the taxable income. We say for 2023. Tuko hapa. Taxable income for 2023. For the income that is basically earned in Kenya, we only have employment income. Do you have investment income? Do we have investment income? Or do we have investment income? There's none. So this was a much easier question. So taxable income in Kenya. So we have employment income, what we call employment income. We have it in Kenya. So what is the employment income in Kenya? Give me the figure for the employment income in Kenya. Give me the figure for the employment income. For the sake of entries, what is the employment income in Kenya? The figure is 720. The figure is 720, but you don't have investment income. So then the next is employment income. Employment income employment, income, we say in Zambia, employment income in Zambia. So do we give the net figure or the gross figure? Do we give the net figure or the gross figure? The gross, what is the gross? You add back the net. Add back the net to get the gross. So the gross figure should be 540 plus 78,000. So what is the gross figure? Give me the gross figure. So the gross figure is 6. So somebody gives me a 618. Do we have 618? 618. Then I want us to get the total tax, total taxable income. Total taxable income. Total taxable income. Total taxable income. So that should be 1338. 1338 together. So then you get the tax payable on the total income, tax payable. I want to use that format, tax payable. I want us to get the tax payable. I want us to get the tax payable. Tuko pamoja on the tax payable. On the tax payable. Tuko pamoja on the tax payable. We respond with a yes. So I want us to picture the tax table for us to get the tax payable on the total income, the tax payable basically on the total income, the tax payable. Do we look at, where do we look at? Do we look at monthly or annually for individual? Do we check the monthly or annually? Where do we check? Do we check monthly or annually? Tunaangalia monthly or annually? Which one would you use? Mary. Remember, these incomes are for the whole year, so we use annually. So on that tax table, angalia malipa annually. So we told that the first 288 we tax at 10%. So what is 10% of 288? What is 10% of 288? What is 10% of 288? So the 10% of 288, that should be 28,800. We respond with the yes if you're there. 28,800. Tuko pamoja. Perfect. Then the next we're being told that between 288 and 388 is 25%. So that should be 100,000 times a figure of 25% times a figure of 25%. What do you have? 100,000 times a figure of what we call 25%. 100,000 times a figure of 25%. What do we have? So that should be 25K. And I hope everybody's following. Are we together? I hope everybody's basically following. So then we're being told that once we have that, so basically being told that between 388,000 to 6 million, that should be taxed at 30%. Do we surpass the threshold of 6 million? Are we surpassing based on total income? Are we surpassing the threshold of 6 million, particularly on our taxable income? Do we surpass that? So we don't pass that. So we just use our taxable income. That should be 1338 minus 388. So the difference, then we multiply by 30%. So what is that difference we multiply by 30%? That difference we multiply by 30%. So when you have that, what do we get? We get what's called the gross tax. So the gross tax. The gross tax. So you get what's called the gross tax. The gross tax. So you get what's called the gross tax. So give me the gross tax. You get me the gross tax. Give me the gross tax. The gross tax. Tuko pamoja. Tuko pamoja. So we can decide to less personal relief or we hold on personal relief. Do you want us to less the personal relief? Do you want us to less the personal relief? So we can less the personal relief. Less what we call the personal relief. So when you less the personal relief, you understand it's 28,800. So this is what we call the net tax payable on total income. Net tax payable on total income. What is the net tax payable on total income? What is the net tax payable on total income? When you less the relief, personal relief for that here, what is the net tax payable on total income? That should be 310. 310, is this? This was 800. Was this? This should be 800 because it's 8. Is 310 the answer? Tafadhali. 310 is 310 the answer? We just confirm. If 310 is the answer, you give me a yes. Give me a yes if 310 is basically the answer. Tafadhali munipatie yes if 310 is the answer. Miriam, Lenovo, perfect, Robert. So then this is total income abroad and in Zambia. So we get the tax on income and in Kenya. And in Kenya. Tax on the income that basically is earned in Kenya. How much is earned in Kenya? So the income that is basically earned in Kenya is 720. Are we in agreement? Out of the two, the income that is basically earned in Kenya is 720. Are we in agreement? So we get the tax basically on the income that we say is earned in Kenya. Together, team, the tax on basically income that is earned in Kenya. Again, this is annual. So we say that the first 288,000 we multiply by 10%. So what is the 10% of that? Give me the 10%. So 10% of that should be, we have it as 28,800. Then you're being told that between 288 to 388, we have 100,000. That 100,000 should be at the rate of 25%. So 125%, we have a figure of 25,000. We have a figure of 25,000. Then you're saying that excess of 288 to 6 million, we tax at 30%. Is this income in Kenya surpassing a threshold of 6 million? Does 720 surpasses the threshold of 6 million? No. So just say that taxable income is 720. So we have 720. We say minus 388 minus a figure of 388 times 30%. So what do you get? What do we get? What do you get? Give me that. What do we get? What do we get? So maybe gets me 99, 600. So what is the gross tax? Gross tax. Gross tax, so what is the figure for the gross tax? gross tax. So we have it as 153. So what is the personal relief? That should be 28,800. So what is the net tax payable on income? That is basically net tax payable. Net tax payable. What is the net tax payable on basically income that is earned in Kenya? So we have 124,600. Somebody says 124,600 together. We respond to the yes kama tuko pamoja. Tax on tuko pamoja. So what is the next step? The next step is basically tax on income and abroad. So remember, tax on income that is and abroad based on Kenyan rate. So that should be the difference between, what should be the difference? Tax on income that is basically and abroad. So tax on the income that is basically and abroad. Tax on the income that is basically and abroad based on Kenyan rate. Is the difference between, what is the difference, Miriam? That should be the difference between, total minus in Kenya. So that should be 310 minus 124. So what is the tax on income that is earned abroad? So provide, if you get the difference, so the difference is 185,400. So we determine what's called double taxation relief. Double taxation relief. So we compare, that is 185,400. How much was the tax abroad? It is given. How much was the tax abroad? How much was the tax abroad? So which one do we choose? Somebody, Chengo. Out of these two, which one do we choose? 28 together. But basically on conditions that we basically set for double taxation, we basically understood that the tax that is charged abroad is normally less than the tax that is charged in the country. How it together? In most cases, based on condition, this one on abroad should be lower than the one in the country. Then that is not over at that point. So then we are being told, lastly, we are being told, is it here? Lastly, we are being told. So we get what's called the double taxation relief due to Tamala and net tax payable, if any. So we can get the net tax payable. So we can get the net tax payable. So the net tax payable, that should be, we have it here, tuko pamoja. So we have it as 310 minus less what's called the double taxation relief. So which we know that 185,400 you compare with 78 and the lower. So the lower is 78. Why am I not using the net? Why am I not using personal relief? Net tax payable. Why am I not using relief? Mbona sijatumia relief of this? Mbona sijatumia relief? Why have I not used relief? Why I'm saying as is, why do I not use relief? Because it's already as a tax credit, it's already factored. So what is the net tax payable? Some people will use this and less with this. 338,800 minus 153,400. Is it the same figure? 338,800 minus 153. Are we getting 124? Let's say, for example, you've not factored the relief, and you say 153,400 minus 338,800. Are you getting the same thing? Are you getting the same thing? I'm saying, let's say, for example, you've not factored the relief. If you want the relief to be one of the tax credit year, if you less this minus this, are we having the same thing? Because in some scenarios, some students will forget to factor this relief so that it uses the relief year. So do we get the same thing? I'm asking a question, class. Yes, we still have the same thing, but you'll only remember, you'll still remember that. What are you going to remember? You're going to remember in that scenario, now you're going to factor the relief here. Now you're going to factor the relief there. So what is the net tax payable when you less those two? What is the net tax payable? I want the net tax payable. So we have 232. And that's it. Tumemaliza hiyo swali. And that's it. Tumemaliza hiyo swali. And that's it. Na tumemaliza hiyo swali. Tumemaliza swali. Tumemaliza hiyo swali. As easy as that. Is that question not easy? Is that question not doable? Is that question 5 over 5? People are happy, 5 over 5. Yes, 10 entries that we should be able to have 10 entries there. 10 entries, we should be having 10 entries there. The first entry, this, then we have this. Those are 3, 4, 5, 6, 7. We have 7. We have 8. We have 9, 10. Or we can give one of the relief for 11. So any 10.
The subsidiary is operating in what? In Rwanda. So this is basically a foreign or basically overseas what? A subsidiary. Now in this case, how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency. Using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling. This one using the Rwandan franc. It is obvious that if you are preparing the group account, there is no way you can do a direct consolidation. You can do a direct consolidation. You take the asset and liabilities, revenue and expenses of the two companies, you combine them. You can't do that because you can see those currencies are different. The financial statement of the parent company is prepared in Kenyan shillings, and the financial statement of the subsidiary are prepared in what? In Rwandan franc. So in this case, we are going to look on how do we translate, how do we do the translation. But even before we do that, we look on that, and maybe there are some two terms we need to define here. One is something called a presentation currency, the presentation currency, and also something called the functional currency. The functional currency. So when we talk about the presentation currency, this is basically the currency which is used by the parent company in preparing the group account. The currency used by the parent company, currency used by the parent company, to prepare the group accounts, to prepare the group what? Account. In most of the cases, if the parent company is a Kenyan company, this one will be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group accounts using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group accounts is called the presentation currency. On the other hand, when we talk about the functional currency, this is basically the currency, the currency of the primary economic environment, in which a company operates, in which a company operates, in which a company do what? Operates. So basically that local currency of the country in which the company operates. So if the parent company is operating in Kenya, the functional currency is Kenyan shillings. If the subsidiary is operating in Rwanda, the functional currency or the local currency for that country is Rwandan what? Is Rwandan franc. So therefore, in this case, when preparing now the group accounts, we are saying, before you proceed basically to do the consolidation, before you proceed to add assets, liabilities, revenue, and expenses, those of the parent company, this particular foreign subsidiary, it is important for the financial statements of the foreign subsidiary to be translated into the presentation currency. Into the presentation what? Currency. Remember, you said the presentation currency is that particular currency which will be used by the parent company in preparing the group account. If the parent company is operating in Kenya, it will prepare the group account using what? The Kenyan shilling. So therefore, before we combine similar items of asset, liabilities, revenue, and expenses, those of the parent company, those of the foreign subsidiary, asset, liabilities, revenue, and expenses of this company, that is the foreign subsidiary, must be translated into Kenyan shillings, which is the presentation what? Currency. So how do we do the translation? These are the translation rules. These are the translation rules. And this basically what is very, very important you need to remember. Number one, when translating the items of incomes and expenses, and remember in this case, what we are translating are the incomes and expenses of this foreign subsidiary. So we translate them, they are translated, items of incomes and expenses are translated using something called the average exchange rate. The average exchange what? The average exchange rate. Because in most of this particular question for foreign subsidiary, you'll be given usually 3 exchange rates. You'll be given the exchange rate at the start of the year, the exchange rate at the end of the year, and also will be given the average. So in this case, we translate incomes and expenses of this foreign subsidiary using what? Using the average exchange rate. The average exchange rate. Number 2, when translating the asset and liabilities, of the foreign subsidiary into a presentation currency, these ones are translated using the crossing exchange rate. The crossing exchange rate. This is actually the exchange rate at the end of the year. The exchange rate at the end of what? Of the year. So if you're able basically to know that, then this particular question account whereby we have a foreign subsidiary presentation currency, there is something which is known as the translation, or basically yes, the translation currency difference, or can we just refer to it as is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference or this exchange difference can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to a translation. This arises due to translation of basically three items. One of which is goodwill. is goodwill on acquisition. Goodwill on acquisition. Number 2 is a profit for the year. A profit for the year. A profit for the year. And number 3, the subsidiary company opening net assets. So opening net assets. Opening net what? Assets. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those 3 items, the translation of those 3 items. So I want us to look on how we determine this currency translation difference, which basically arises from translation of those 3 items, the goodwill, profit for the year, and the opening net assets of the subsidiary. So let's start with the goodwill. The goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net assets which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the fractional currency, using the fractional. The fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using the goodwill is computed using the fractional or the local currency of the foreign subsidiary of the foreign subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, into presentation currency. Translate that into presentation currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill, goodwill. So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operating in Kenya, but the foreign subsidiary operating in Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. The rate of exchange, you'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition. The goodwill at the date of acquisition, you'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the fractional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average, and then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here, that now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. The value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what we refer as exchange difference. And this exchange difference can either be an exchange gain or an exchange what? Loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease, like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, part of other comprehensive incomes. So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry, we add this to the profit for the year, to the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill, translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns. The local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net asset. The opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary will have been acquired at the start of the year. So take the opening net asset. The opening net asset on the date of acquisition in in local currency, for example, rand and franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value here, and then to this you add the profit for the year. The profit for the year, and remember this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be affected in the income statement of the subsidiary, like a depreciation, other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can devalue assets, like maybe item of PPE or even things like intangible assets, like maybe brand or something like that. So if the foreign subsidiary devalued some assets, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation other charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate, the average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the closing net assets. The closing net asset of the subsidiary. We translate that now into presentation currency using the closing exchange rate. Using the closing exchange rate, we get now the translated value there. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember this net assets. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes. Will be recognized there as part of the other comprehensive incomes. So basically this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of assets, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. The exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I'll say for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of assets and liabilities, those of the foreign subsidiary, will be translated using the closing exchange rate. Closing exchange rate. So if you can be able to record that, basically this one is quite simple. Quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. April 2022, which is the question number 1. Question number one. April 2022. So if you're there, you can just confirm Yes, are you there? Are you there? Okay, okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the securities exchange. Listed in the securities exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those that statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we have said even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings, that of the foreign subsidiary is in franc. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net assets and the goodwill on acquisition of the foreign subsidiary. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. Group structure. And the group structure. So where do we have information about the group structure? We have that information in note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million, 1 franc ordinary shares for a cash consideration of 35.50 million franc. So this company acquired S Limited, and basically this S Limited, remember, we are told is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign subsidiary. In other terms, is a foreign. Yes. So in this case, we have the parent company and basically the foreign subsidiary. As per that note, we are told the acquisition took place on 1st of January 2021. So that is the date of acquisition. Remember, I've said in all these particular questions for foreign subsidiary, usually the subsidiary is acquired exactly at the start. So it was acquired on 1st January 2021. That is the date of acquisition. When are we required to prepare the group account? The date of consolidation, though. So in the requirement, specifically in Roman Part B and Part C, we're required to prepare the group account for the year which ended 31st of December 2021. You can see our subsidiary was acquired exactly at the start of the year. Sasa, yes, we say it's always important for you to note the date of acquisition. So we have that information there. That is the group structure. P is the parent, S is a foreign subsidiary. Now, in that case, we are given the purchase consideration which was paid, which was 35.50, and actually this is in franc. Then no working which is required there, but we are going to use that information in computation of goodwill. In Part B, also not Part B, rather note 2, we are told at the acquisition date, the carrying value of S Limited net asset was 2,600 million franc, but the fair value was 3,200 million. In other terms, this company revalued the assets. On the date of acquisition, revalued its net asset. We are told the net asset had a fair value of 3,200 million franc, and the carrying amount of this net asset was 2,600 million. So it basically means that in this case, we have an increase in the value of the asset by 600, which automatically is a revaluation what? Gain, is a revaluation gain. So, and then you're told the excess in the fair value of the carrying amount was due to unrecognized branch with a remaining useful life of 5 years at the date of acquisition. So we are told this revaluation gain is due to a brand. In this case, a brand is basically a form of a brand is a form of a trademark. In other terms, a brand, this one, this is a form of an intangible asset. This is a form of an intangible asset. Just like the other question we did, whereby we were told that the subsidiary on the date of acquisition valued, or basically there was a list of customers which was not yet recognized. And we say that list of customers should be recognized as what? As an intangible asset. The same case with this particular brand. So what is the value for the brand? So the unrecognized brand. Unrecognized brand. And basically we are saying that this unrecognized brand, this is a form of an intangible asset. A form of an intangible asset. So the value for this brand would be the difference here. It will be equal to 200 million franc minus 26. This will be 600, or this will be 600 million franc. Remember, this particular asset here was revalued on the date of acquisition. So how are we going to account for this amount here? This amount of 600. So this amount of 600, number one, this one will be recognized as an intangible asset, within the consolidated statement of financial position. Is an intangible asset. Number two, this one is a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation what? Reserve. So that's the first thing you need to know. And then in the same point, we are told that this particular brand had a remaining economic useful life for 5 years at the date of acquisition. Remember, I think in most of the questions which you have done, we were told the item which was revalued was an item of PP. What we were doing, we were computing the depreciation at the charge. In this case, do we depreciate intangible assets? No, we amortize. So what we need to do here is basically we compute the amortization, because what we say is that once the subsidiary company has revalued the asset, the subsidiary company do not account for that revaluation. So what we need to do is to compute the amortization for this brand. The amortization, we compute this using the same formula we were using to compute the depreciation at the charge. We take the revaluation gain for the value at which the asset was revalued at. We divide that with the remaining useful life or economic life. And I think we are told the remaining economic or useful life in note number 2 were 5 years. 5 years, we divide that with 5, and then we should multiply that with the proportion of time. The proportion of time is the time we have between these two dates. In this case, we have 1 year. So we are interested with amortization for just 1 year. For just 1 year. So this will give us what? This will give us 120 million. And it is also important for you to note that this 120 million, this is still in franc. This is in foreign subsidiary. This is in foreign what? Subsidiary. So this one, this amortization, number one, this one is basically an expense. It's an expense within the consolidated income statement. And number two, this one will be deducted from this. So this one will be deducted from intangible assets. So the value for intangible asset would be 600 minus this one, which is basically 120. So I think we are done with that. Let's move to the other point. So let's move to the other point. So in point number 3, we are told the non-controlling interest in 𝐻 Limited as at the date of acquisition was fair valued at 1450 million franc using the fair value model or the fair value method. So it basically means that in computation of goodwill, we are going to use the full goodwill method. That's why we are given the NCI at fair value. So, and then number 4, we are told as at 31st of December 2021, that is at the end of the year, it was determined that the goodwill arising on acquisition of S was impaired by 10%. That is the impairment loss. Okay. So number 5, we are given the exchange rate. We are told the foreign exchange rate are relevant. So what you must be in a position to do is to interpret those exchange rates. For example, we are given the exchange rate on how many days? We are given 3 exchange rates. On first, at the start of the year, which is the opening, we are also given the closing exchange rate, and then you are given the average. You're given what? The average. So how do we interpret that? For example, the exchange rate here at the start of the year. So it is given up there, you can see franc to 1 Kenya shilling. Franc to 1 Kenya shillings, and the opening is 5. So this means that the opening exchange rate is 5 franc. 5 franc, this one is equal to 1 Kenya shillings. Sasa, is that basically the interpretation of that? That 5 franc is equal to 1 what? Kenya shillings. Sasa, yes. So that's basically what we have. And I think now having that information, we can just go straight to answering our question. Let's just go direct to answering our question. But I think before we do that, we start, basically we're going to start with Roman 1. I think the first thing we need to do is let's compute the goodwill arising from acquisition. And remember, you have said we compute the goodwill arising from acquisition of this subsidiary using the foreign currency. The foreign currency of 𝐻 Limited is franc. We compute that goodwill using franc, and then we are going to translate it into Kenya shilling. In the process of doing that, we are going to determine the exchange gain or loss as required in Roman 1. So let's do that. And basically that will be part of the workings. And then we will be able to use that goodwill, to compute the exchange difference. So remember, in this case, the method we are going to use is the full goodwill method. The full goodwill method. So at the full goodwill method, here we just need to have, let's just have one column. We are computing this in franc. In franc, the foreign currency, the franc, and the figures are given in million of shillings. So goodwill using the full goodwill method, or we compute the goodwill using the full goodwill method by, number 1, taking the purchase consideration which was paid by the parent company. To this, we add the NCI at fair value. At fair value. Remember, we are computing this using the foreign currency, the local currency, which is franc. So this purchase consideration, which was paid by the parent company, that one is within note number 1. Note number one, which is given in franc, and that is 3550. 3550. So we also have this one, NCI at fair value, in note number 3. Note number 3. So the NCI in 𝐻 Limited at the date of acquisition was valued at 1450 million franc. So we add these two values. What do we get? What are we going to get here? Is it 6,000? 6,000 franc? What are we going to get there? Purchase consideration paid by the parent, note 1, 3550, plus the NCI at fair value in note number 3, 1450. That will give us 5,000. That will give us 5,000. 5,000. So then to this, we proceed and we less the fair value of net assets acquired. So in our case, we know at the date the subsidiary company was acquired, the fair value of its net asset, as per the information we have in note number 2, the fair value of its net asset is already given, this one. It was 200 million franc. That is still in franc. Now, take into account we are using the full goodwill method. We will take 100% of this. We are using a full goodwill method. we take 100% of that. So the goodwill arising from acquisition, the goodwill arising from acquisition is how much? Goodwill arising from acquisition is how much? Yes, the goodwill arising from acquisition is 1,800 million. 1,800 million. It's also important for you to note that this is still in, this is in foreign currency. This one is in franc. Now, having that, I think we can just go straight to part A of that question. Part A, and basically we are required to compute the exchange difference. The exchange what? The exchange difference, which is basically a gain or a loss, on translation of two items, net asset and goodwill. So we're going to start by computing the exchange difference on translation of goodwill. On translation of goodwill. Translation of goodwill. Translation of goodwill. Translation of goodwill. So this one is very, very simple, very, very simple, provided you can be able to remember the format which I've given you for computing this. If you can be able to remember that format, this one is quite simple. So in this case, we need to have various columns here. The first column here will be for the foreign, the local currency of the foreign subsidiary, which is franc. We have the exchange rate, and then we are translating that to Kenyan shillings. And our figures are in million of shillings. Are in million of shillings like that. So what we start with here, we start with the goodwill on the date of acquisition. The goodwill on the date of acquisition. So the goodwill on the date of acquisition is this one. That is 1,800. 1,800. So we translate this into Kenyan shillings using which exchange rate? Which exchange rate do we use here? Remember, this is the goodwill on the date of acquisition, 1st January 2021. Is that the case? So we translate this using the opening exchange rate. The opening exchange rate as per note number 5 is 5. And basically that is 5 franc, which is equal to 1 Kenyan shillings. So how do we translate this into Kenyan shillings? Remember, this is franc. This is 1,800 million, sorry, 1,800 million franc. We want to translate that into Kenyan shillings like that. So basically we need to cross multiply, then we divide. So we take 18 times 1 into divided by 5. In other terms, what is important for you to note here, when translating, in translating franc into Kenyan shillings, you'll take the figure which is in franc, you divide that with the exchange rate. Like in this case, 1,800 is in franc. To translate that into Kenyan shillings, you divide that with the exchange rate. If you know that now, it becomes much simpler. Yes, because you'll be taking all the figures in franc to divide to translate them into Kenyan shillings. You divide that with the respective exchange rate. So we will divide that with 500. So we take this divided by 5, not 500, sorry, by 5. That will give us what? That will give us what? We try to hurry up. We try to hurry up. So that one will give us 360. That one will give us 360. And then out to this, we have said we need to less the impairment loss. The impairment loss. So the impairment loss, we are given that information in note number 4. Note 4, we are told as at 31st of December 2021, it was determined that the goodwill on acquisition of S was 10% impaired. So this goodwill was 10% impaired. 10% of this is 180. 180. So first of all, we need, this is an item of expense. Being an item of expense, we will translate that into Kenyan shillings using the average exchange rate. The average exchange rate as per note number 5 is what? Is 4. Is 4. So we take this divided by 4. What do we get? 180 divided by 4. That will give us what? That will give us 45. 45. Then what we do, we take, remember this one should reduce the value for goodwill. So what you do, you leave 2 lines there. And then we will have the value for goodwill at the end of the year, that is on 31st of December 2021. So this minus that basically that will give us what, 1800 minus 180. That one will give us 1620. So that is the value for goodwill at the end of the year in foreign currency, in functional currency. Sasa, yes. Now, before we proceed to determine the exchange difference, which is a gain or a loss, first of all, get the difference between these two values. Write that value here. Write that value there. Oh, sorry. So this one should be 6. The average is 6, not 4. The average is 6. Yes, thank you for that. The average is 6, not 4. The average is 6. So this one would be 30. That one would be 30. Is that the case? Yes, 180 divided by 6 is 30. Is 30. The average is 6. Yes. So we get the difference between this, which will give us 330. 330 equally, ensure you have a line here. Then what we do, we translate this goodwill at the end of the year into Kenyan shillings using the closing exchange rate. The closing exchange rate is what? Is 4. So we take this divided by 4, and that now will give us the value for goodwill at the end of the year in Kenyan shillings divided by 4. That will give us what? 405. Now then we compare these two values here. We compare those two values there. We determine we have an increase or a decrease from 330 to 405. What is that? That one is automatically an increase. Is automatically an increase. An increase of what? An increase of 75. So being an increase, we refer to that as the exchange gain. As the exchange what? Gain. And basically I've said that this one within our consolidated statement of profit or loss is part of other comprehensive income. Is part of other comprehensive income. So basically that's how we compute the translation or the exchange difference, which is the exchange gain or loss arising from translation of goodwill. Arising from translation of goodwill. So then still in Roman 1, we need to compute the exchange difference, which is gain or loss, which arises on translation of net assets. Translation of net worth, asset. Translation of net assets. Translation of net assets. So we need to have the same format here. The local currency or the functional currency of the foreign subsidiary, the rate, and the presentation currency, which is Kenyan shillings. So here we start with the opening net assets. So the opening net assets is what we have here. So we know that at the date the subsidiary was acquired, it revalued its net assets, and the net asset of the foreign subsidiary had a value of what? 32. So that is the opening net asset. The opening net asset of the foreign subsidiary. So we need to translate that into Kenyan shillings using the opening exchange rate. The opening exchange rate is 5. This one. The opening exchange rate. The opening exchange rate. That will give us what? 32 divided by 5. So which will give us what? 6. I'm getting 640. Are you getting 640? Yes, 640. Then to this we have said we add the adjusted profit for the year. The profit for the year of the foreign subsidiary. And basically that one should be the adjusted one. The adjusted one. So let's go to the income statement of S Limited, which is a foreign subsidiary. From the income statement of S, how much was its profit for the year? Its profit for the year is 1,500. Is 1,500. 1,500. I hope you can be able to see that. From the income statement of S, its profit for the year, is that 1,500? 1,500? Yes. Now, I'll say you need to check whether this foreign subsidiary that is S, whether it had something like depreciation, undercharge, depreciation overcharge, maybe something like amortization, which was not yet accounted for. So in our case, what we have is this amortization. Remember, 𝐻 Limited didn't account for this revaluation of asset. It never accounted for this amount. It equally never accounted for this what? Amortization. So if this amortization was accounted for, automatically that one was supposed to be deducted in arriving at this what? Profit. So we deduct that amortization from that profit for the year. That will give us what? That will give us 1380. Is that the case? 1380. 1380. Are you getting 1380? 1380. I'm not getting answers today. I'm not getting answers. I'm not getting answers. Karaja, I need to get answers. Peter, I need to get the answers. Once you get the answer, type it in the chat box. Type the answer in the chat box. Type the answer in the chat box. Yes. Now, in this case, we have said that this being the profit for the year, we translate it into presentation currency using the average exchange rate. The average exchange rate in our case is what? A6. A6. So we take 1380 divided by 6. 1380 divided by 6. Divided by 6. That will give us what? That will give us to 30. So then what we need to do, make sure you leave 2 lines here. And then we have the net asset, the crossing net asset, the crossing net assets. The crossing net asset will be this plus this, which will give us 4580. 4580. And actually, this one should always reconcile. This one should always reconcile with the net asset of the subsidiary at the end of the year. Remember how we compute the net asset of a subsidiary. We said you can either take asset minus liabilities or equity. We said in group accounts, we compute the net asset as the share capital plus reserves. So if we go to the statement of financial position of this company, that is S, what is the value of its net asset, which should be the share capital plus reserves? So the net asset of S at the end of the year, which is the share capital plus the share capital plus reserves. Can you see that figure? I can see that as a figure of 41. Is that the figure? 41. The share capital plus the reserves. Yes, you can see it's not reconciling with this. The reason being that there are a number of items which our company had not accounted for. This company revalued the asset, but never accounted for that. Remember, if 𝐻 Limited had accounted for this amount of 600, this was supposed to be accounted for as a revaluation reserve. Being a revaluation reserve, it was supposed to be included here. The company was supposed to add 600, and then the profit for this is also part of this. Profit for this is part of this. So the company was supposed to deduct or to have accounted for this as an expense. Was it accounted for? No. So that 120 should be deducted from that value there. And if you work out that, it should give us this value there. It should give us that value. So the reason why those two figures are not reconciling this and this is because our company had not accounted for those two items. If you work out that, is it now reconciling? Is it reconciling? Yes, it is reconciling. Now, what we need to do then, we translate this into presentation currency using the crossing exchange rate. Using the crossing exchange rate, 4580 divided by 4. That will give us 1145. 1145. 1145. So then what we need to do is basically we add these two values, which will give us 870. And then we compare this and this. We compare that with that. We determine, do we have an increase or a decrease? I can see we have an increase. An increase is an exchange gain. Is an exchange gain. Is an exchange gain, of which this one will be part of other comprehensive incomes. So which I'm told is 275. 275. Yes, in our case, we are done. We are basically done. That is what was required as far as that question says. That is part A of that question is concerned. By doing that, you get 6 marks. I want us then we move to part B of the question, which is very, very simple. Very, very simple. You'll be able to see that. Part B, what are we required to do? We are required to prepare the consolidated statement of a profit or loss, which is basically for the year, which ended 31st of December 2021. 31st of December 2021. 21. Now, how do we prepare this one? We prepare that by consolidating, by basically combining similar items of revenue and expenses, that of the parent, that of the subsidiary. But we have said before we do that, we have to translate items of revenue and expenses of this foreign subsidiary into Kenya shillings. We have said to translate this, we always use the average exchange rate. The average exchange rate. So let's just do that translation here as we prepare this. So this will be in Kenyan shillings, and our figures are in million of shillings. So we go back to the statement of profit or loss for individual companies, which is given, I think, below paragraph 2 of our question. We take the revenue of the parent, which is 2145, plus the revenue of the subsidiary, which is S, that is 10,500. But because this one is in franc, we need to translate that into Kenyan shillings by dividing that with the average exchange rate. Dividing that with the average exchange rate. So the average exchange rate, as per the information we have in note number 6, is note number 5. The average exchange rate is 6. So do we have any adjustment here? No, because the only adjustment affecting revenue is intergroup trading. Do we have any amount of intergroup trading? No. So we just need to get the final value here. 10,500 divided by 6 plus 2145. I'm getting 38.95. 38.95. So then from there we check the cost of our sales. Cost of our sales, we do the same. We check that of the parent, 915, plus that of the foreign subsidiary, which is 63. We divide that with the average exchange rate, which is 6. Do we have any adjustment here? No, because we know that the only adjustment which is effected here is adjustment for ungauged profit, depreciation and other charge, which we don't have. We don't have any of those adjustments. So just an issue of translating 63 divided by 6, 1050 plus 915. So which will give us 1965. So we less that from the revenue, we get the gross profit. We get the gross profit. The gross profit. The gross profit will be how much? The gross profit. The gross profit, I'm getting, yes, I'm getting that in what? 90. So then from there we have the distribution cost. The distribution cost, in all questions for group account, we said these items do not have any adjustments. Just maybe translating the distribution cost of the subsidiary into what? Into the presentation currency, which is basically 750. I will equally divide that with 6. I will equally divide that with 6. And I hope you can see what we are translating is only this of the foreign subsidiary, not the total. Not the total. 750 divided by 6 plus 150. So that will give us 275. Then from there we have administrative expenses. Now for the administrative expenses, we have that of the parent, which is 345 plus 1350. This one we divided with 6. Now in this case, there are two items we need to capture here. One, we have a company here. The amortization. Remember, this amortization was not accounted for. We said amortization, that one should be included as part of administrative. And because it is still in franc, we added to this. We are going to translate all this using the average. All of them are items of expenses. The other item we also need to capture here is this impairment loss. The impairment loss, this one. So let's have here still in franc, that is 180. Understand? Yes, you can see this is in franc, this is in franc, this is in franc. Get the total expense of the subsidiary, and then we divide that with the average. We divide that with the average. Understand? Yes. 1350 plus 120 plus 180. We divide that with 6. 275 plus 345. And in that case, I'm getting 620. I hope that is what you're getting. Is that what you're getting? Is that what you're getting? Yes. So then we get the operating profit. So this minus the two expenses. 1930 minus 275 minus 620. So I'm getting operating profit of 1035. Can you see how simple this is? Can you see how this simple this is? This one is a question they keep on repeating. And this question, I think, was still tested some time back. They keep on repeating this question here. So this is this kind of area, which is very, very important, which is very, very simple. That is. So then investment income. Investment income, we take that of the parent, which is basically 50, and the subsidiary 0. So nothing need to be translated there. And then we have the finance cost. Finance cost, we take that of the parent plus that of the subsidiary 150, you divide that with 6. And no adjustment here. So you take 150 divided by 6, 25 plus that which will give us 55. Yes, so then we get the profit before tax. The profit before tax, which is this. So this investment income, sorry, should be added because this is an income. This one to be deducted. So 1035 plus 15 minus 55. So that will give us 995. And then out to this we less the income tax expense. So the income tax expense also is another an item which is adjustment. Although in this question there is nothing which was to be adjusted except the administrative expenses. So 165 plus 450, we divide that with 6. 450 divided by 6 plus 165, which will give us 240. And then we get the profit for the year. The profit for the year. So this will give us 755. So to this then, finally, I hope you can see there is nothing else which is given in that statement of profit or loss. But here we must proceed and add something called the other comprehensive incomes. The other comprehensive income. So what do we recognize here as other comprehensive incomes? So these exchange gains. The exchange gain on translation of goodwill, exchange gain on translation of net assets. So the exchange gain on translation of goodwill, which is 75, and also on translation of net assets, which is 275. And we get what? We get the total comprehensive incomes. We get the total comprehensive incomes. So I'm getting 11 what? I'm getting that 1105. Are you getting that value? Yes. So basically that is it. That which was required in part B of that question. And basically these are the items which are marked in that question. So by doing such, the marks allocated there were 6. So let's move to the other part of the question. And that is the statement of that is part C, the consolidated statement position as at 31st of December 2021. 31st of December 2021. Yes. So how do we prepare this one? We prepare this basically by combining, by adding together similar items of assets and liabilities, that of P, that of S. But now, remember the assets and liabilities of the foreign subsidiary are in franc. We translate them into presentation currency using the closing exchange rate. That is what is important here. So we will start with an non-current asset, and remember our figures here will be in Kenyan shillings. In Kenyan shillings here. So we start with the non-current assets. The non-current assets. So for the non-current assets, we have the PPE, property, plant, and equipment. So we will take that of the parent, which is 4850, plus that of the S Limited, which is 7,000. And then now we divide this with the closing exchange rate. The closing exchange rate as per note number 5 is 4. So no adjustment here because there was no item of PP which was revalued. So we just get the final value. So I'm getting what? I'm getting 66. I'm getting 66. Are you getting 66? Are you getting 66? Yes, 66. So down there, what we have is the investment in S. The investment in S is automatically the purchase consideration, which was paid by the parent company in acquiring shares of S. I hope you can be able to remember that amount. It was here, this one. It was 3550, but now this amount, this one is in franc. Automatically, this one was translated into Kenyan shillings at the date the purchase consideration was paid. The purchase consideration, this one was paid at the start. So this one was translated into Kenyan shillings using the opening exchange rate, which is 5. So if you divide that with 5, that will give you what? 710. So, but do we include that amount here? No, we don't include the purchase consideration paid in acquiring a subsidiary here. What we include instead, we include the goodwill. The goodwill on acquisition of S. And the goodwill on acquisition of S at the end of the year is basically what we have here. This goodwill, which has already been translated in Kenyan shillings. This one, 405. That one, Sasa? Yes. So the other item which you must also remember to include here, because we don't have any other non-current asset, remember the subsidiary revalued this brand. We can just include it here as unrecognized brand. So the brand was valued at an amount of 600, but it was supposed to be amortized with an amount of how much? 120. So we left 120. But now, remember these figures are in franc. That now will give us the unrecognized brand at the end of the year. So which will be 480. We need to translate that using the closing exchange rate. I hope you can see what I've done. 600 minus impairment loss. That will give us 480, which will be the value for unrecognized brand at the end of the year. But still in franc, we need to translate that using the closing exchange rate, which now will be 120, because it is 480 divided by 4, 120. So we move, and then we record the non-current asset. Sorry, the current asset, that is. I think we can do away with this one. Yes, so we record the current asset now. The current asset. So for the current asset, we have inventory. We take that of the parent, which is 1030, plus that of S, which is basically 24. We divide this with 4. That will give us 600. That will give us 1630. We have trade receivables. We take 970 plus 1960 divided by 4. Yes. So no adjustment here. You can see we don't have any adjustment. I'm told it's 1460. I'm told that is 1460 by Mercy. I hope that is correct. I hope that is correct. Okay. So then from there we have the cash and cash equivalents. So we do the same. We take 4 for 10 plus 540 divided by 4. No adjustment still. Yes, what are you getting? Yes, 545 like that. 545. Okay. So basically we are done with that. We said in this question, never bother yourself getting totals. What is marked are these. These are the entries which are marked. Never bother yourself getting totals. So then we move and basically we record what? We record equity. So we start with the ordinary share capital. So for the ordinary share capital, basically we know that we only include the share capital of the parent. The share capital of the parent, which is 15. So below that we have a share premium. Share premium. Share premium will also include that of the parent company only, which is 500. Below that, what do we have? We have the retained earnings. The retained earnings, we say no need of computing that. Just that one is just rebate. Don't bother yourself computing that. But now, in these questions, because we may come across a question maybe in the topic when covering cash flow, you see these particular exchange differences which you have recognized here. When do we have those exchange differences? This one. So we compute the exchange difference, which is basically attributable to the parent company, and we recognize it here as a component of equity. Basically, we refer to that as currency translation reserve. Currency translation reserve. The currency translation reserve for the parent company. So to compute the currency translation difference for the parent, we basically get this total. This will give us a total of what? This will give us a total of 75 plus 275. That will give us what? Is it 350? Yes, and then we compute that of the parent company. That of the parent company will be equal to 80%. That one will be equal to 80% for the parent. That's that? Yes. For the parent, that which we include here. That's why you can see even share capital, share premium, we are including that of the parent. 80% of that will be 280. That one should be recognized there as a component of equity. So then in that case, automatically we can't be able to get the total. So equally below here, there is something else we compute. No need of equally computing this one. Then NCI, we just leave it. And then now from there, we proceed to record the liabilities. We record the liabilities. We start with the non-current liabilities. So for the non-current liabilities, we have 10% boards. 10% boards. I will take that of the parent, which is 820 plus 2640. But this one, remember, we translate items of asset and liabilities using the crossing. Items of asset and liabilities. The crossing is 4. The crossing is 4. That will give us what? 660 plus the 820. Yes, that will give us 14. That one will give us 1480. 1480. So then from there we have the deferred tax. The deferred tax. So the deferred tax will do the same, 740 plus 2160, divide that with 4, and then we get the final value here. What would be the final value? The final value. Is that what you're getting? Yes. So then next we have the current liabilities. The current liabilities. So for the current liabilities, we will start with the trade payables. We will start with the trade payables. So for the trade payables, we will take 1330 plus 2240. We divide that with 4, and then current tax. Current tax, we take 520 plus 760 divided that with 4. Divided that with 4. So that's basically how we get the final values there. So 1890, I presume that is payables. What about the current tax? What about the current tax? The current tax is what? Is 710. Is 7 what? 10. 710, 710, 710. So basically that would be the total equity and what? And liabilities. Total equity and liabilities. So no need of getting the total because there are two items you have not computed up there. And that question, if you do it like that, even if you have not computed the NCI, even if you have not computed the group retained earnings, basically that is the question will be able to score all the marks, all the marks, all the marks. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So 15 out of how many marks? Out of 8. So automatically take into account we have 8 marks, 15 ticks. So this how such a question is marked. For any 8 at 1, you just need to get 8 items correct. If you just get 8 items correct, you have all the 8 marks. You have all the 8 marks, all the 8 marks. And I think that should also apply here. Any 6 at 1, any 6 correct item, you get 1 mark each. By the end of the day, you get your what? Your 6 marks, your 6 marks. So that is it. That's basically how we do the translation and also the consolidation. Can you see how simple this is? Yes, this is very, very simple. This is a question, I think, which has been repeated for a number of times. This question was examined some time back, but they decided to repeat it in this particular sitting here. There is a question I want to give as an assignment. I think the question for which sitting? Yes, this one for December 2023. You attempt this question December 2023, which is basically question number 1. You'll be able to see it's just the same, although this question there was an adjustment affecting I think payables, but just attempt it. Maybe during our revision, we will be able to see whether we will get some time and look on that question. But that is it about regarding the foreign or the overseas subsidiary. It basically means that once now we meet next week, we are basically finalizing on this. We are finalizing on this because now what is remaining is on group cash flow, or basically the consolidated cash flow. That is what is remaining. But automatically we will be able to come back to this topic during our revision, because remember I said that this is a very serious area. If you check on the past papers, you'll be able to see mostly there are 2 questions which come from this topic. 2 questions. A question for group cash flow, and another question for group account. Like the paper which was there last meeting, how many questions were there? I think last meeting I think there was just 1 question. There was just 1 question, which was very simple. Actually, that paper for last meeting, it was one of the easiest paper which has ever been tested. There was 1 question, but if you check on the other paper for, I think, December 2024, there were 2 questions. There was a question for group accounts, I think piecemeal acquisition, and there was a question on cash flow. There was a question on group cash flow. If you check on the paper for August 2024, there were still 2 questions, group cash flow and another question. So that's why I'm saying that this is a very, very common area in the exam. Either you get 2 questions of 20 marks, or basically maybe 1 question. But mostly, I expect 2 questions this sitting, because you can see last time there was no question on cash flow. I expect that will be tested this time, and also another question for group account. Sasa, yes. So for today, we're going to stop at that point. Make sure you attempt that question for December 2023. Once we meet next week, we are finalizing on this, basically by looking on discussing what is the group cash flow, and then from there we will be able to see what is remaining, such that by 21st we should be done with this and we start officially our revision. So let's stop at that point for today. Have a nice weekend. See you next week on Tuesday. Order. How do we determine this particular net cash flow? So to determine this, we take the cash inflow. Basically, when we talk about the cash inflow, this refers to any money which is flowing into the business. Like once the company sell an asset, the company receive money. Once the company issue shares or basically debenture, the company receive money. So the money which is received or money coming into the business, we basically refer to that as a cash inflow. The other rule is that when preparing the statement of cash flow, any amount which is a cash inflow, we record it in our statement of cash flow as a positive. As what? As a positive. So we take the cash inflows, and then to this we less the cash what? The cash outflows. So the cash outflows, basically, this refers to any cash which is flowing out of the business. And the rule is that anytime you are preparing a statement of cash flow and you come across an amount which is a cash outflow, then you record it as what? As a negative. So therefore, to determine these net cash flows, we take the cash inflows as positives, and then we less cash what? Cash outflows. Or basically, we deduct the cash what? Cash outflows. That's why we are saying cash outflows. We record them as what? As negative. So by the end of the day, we will be able to get the net cash flow from operating, investing, and also what? Financing. So maybe the other thing you need to remember very fast is that when preparing the statement of cash flows, basically we have two methods which can be used to prepare a statement of cash flows, or in other terms, to present a statement of cash flows. We have the direct method, and also we have the indirect method. And actually, the difference between those two methods, that is the direct method and also the indirect method. Indirect method is basically how we determine the net cash flow from operating activities. That is the only difference. How we determine the net cash flow from operating activities. That is actually the difference between these two methods. So under the direct method, basically, we determine the net cash flow from operating activities using a direct approach. Basically, we go to the cash book prepared by the company. Number one, we take into account the cash received from debtors or customers, which is basically a cash inflow. Then to that, we less the cash paid to the suppliers or creditors. We also less the cash paid for operating expenses. We also less the tax paid and the interest which was paid. We will be able to get the net cash flows from the operating activities. That is now using the direct method. Now, under the indirect method, we compute the net cash flows from operating activities using using an indirect approach. And actually, what we do under the indirect method, we take the profit before interest and tax, and usually we adjust it with three items. The non-cash items, which were added or deducted in arriving at net profit. Number two, the changes in working capital, basically where we consider three items of working capital: receivable, inventory, and payables. And also we adjust that profit with any investing or financing activity item which was added or deducted in arriving at net profit. So basically, I think that is the first thing you need to remember as far as the statement of cash flows is concerned. And I think with that particular quick recap, I want us to go straight to a question. And there is a question which has already been shared in the class chat box, maybe for those who are joining us right now. So there is a question which has already been shared in the chat box. So if you can be able to see that question, please confirm that is the question you want us to do. Can you be able to see that question, those who are just joining? If you can be able to see that question, please confirm that is the question I want us to do. Can you see that question in the chat box? Can you see that question in the chat box? I want us to use the question from CPA Foundation level. CPA Foundation level. That is the question 4B of August 2024. Yes, so can someone reshare that question afresh? Evans, please reshare that question afresh. Reshare that question afresh. Reshare the question afresh. Yes, so I think it has already been reshared there. It has already been reshared there. So let's go through it. We see what we are told and equally what the examiner was requiring here. So the question reads, part B, question 4B, it reads, the following are the financial statement of Precious Limited for the year which ended 31st of March 2023 and 31st of March 2024. So we're given Precious Limited statement of profit or loss, which is for the year which ended 31st of March 2020. The gross profit, operating expenses. We have other incomes which include interest income received, the gain on sale of investment, and then we have the loss on sale of plant. And then from there we have the interest paid, the interest expense which was paid, and then we have the net profit before tax. We have the income tax for that year, and then we have the net profit after tax. So then from there we have the statement of financial position. We are given statement of financial position basically for 2 years, 2023 and 2024. It is important for you to note that anytime you come across a question for cash flow, always the examiner will give you the statement of profit or loss for the current year. And then for the position, that is basically the balance sheet, you'll be given the statement of financial position for the current year. For example, in a case, the current year is the year 2024. And for the previous year, you need to notice that the figures which are given here in the statement of financial position of the previous year, 2023, these are treated as the opening balances, whereas the figure in the statement of financial position for 2024, those are closing balances. That's basically what you need to know. So we have the non-current assets, which include PPE, property, plant, and equipment, at cost and also accumulated. We have the investment, we have the current inventive cash prepayment, and then we have the total current asset and the total asset. And then we have liabilities and capital, where we have ordinary share capital, revenue reserve. Revenue reserve, this is another name for the retained profit, or is basically another name for the retained what? Earnings. Then from there, we have the long term, which include both. We have the current liabilities, which include liabilities. And then we have tax payable. And then we have the current liabilities, total equity and liabilities. Then we have additional information, number 1, all the way to note number 7. So what then are we required to do here? We're required to prepare a statement of cash flows, which is for the year which ended 31st of March 2024, in accordance with the International Accounting Standard number 7, which governs the preparation of the statement of cash flows. Now, in this case, number 1, recall what we have said. There are 2 methods which are used in preparation of cash flow. We have direct method. But if you check on this particular question, the examiner has not specified which method we need to use, whether we use the direct method or basically whether we use what? We use the indirect method. But anytime you come across a question for cash flow, you are given the income statement or the statement of profit or loss, statement of financial position. If the examiner is not specific on which method to be used, always use the indirect method. So the indirect method basically has so many free marks when it comes to computation of the cash flow from operating activities. So that is the first thing you need to do. The other, assuming this is a question you are doing in an examination setup, it is not advisable to start with the workings, because this where or what make majority of the students to fail in these particular questions. So how do you get free marks, or basically what you refer as the low-hanging fruits? So basically what you need to do is that once you come across a question for cash flow, number 1, never start with the workings. Just go straight to what the examiner is requiring you to prepare, because the 16 marks which are allocated here, they are allocated for preparing a statement of cash flow. So if you do all the workings, they are correct. By the end of the day, you fail to prepare the statement of cash flow, you will get 0. So therefore, what you do, go straight to preparing what is required. Basically, any working which you do it per need basis. You are doing a working to determine an item to be posted in the statement of cash flow. So therefore, what we do, we go straight to preparing what is required. And actually, we need first of all to have the title. And basically, this is the statement of cash flows. The statement of cash flows. And basically for the year, which ended 31st of March 2024. 31st of March 2024. Obviously, you must have the title. You must have the title of what you're preparing. And then from there, you need also to remember, in preparing this particular statement of cash flows, we have to determine net cash flow from 3 activities. So can you have those particular 3 subheadings? So basically, always, we start by determining the cash flows from operating activities. That's basically what we know. We start by determining the cash flows from operating activities. So here we need to have 2 columns, and I hope you can be able to see that if you go back to that question, all our figures are given. The figures in the income statement or the statement of profit or loss, the figures in the statement of financial position, they are given in thousands of shillings. So you need to have 2 columns here like that. So then from there, you leave some enough space here, because when computing the cash flow from operating activities, we have so many items which we record here. So leave enough space. And then from there, you have the other subheading for basically determining the cash flow from what? The cash flow from investing activities. And basically, remember, in this case, we have said investing activities are those activities which involve acquiring assets and also selling assets. So what we record here are the assets which were acquired, the assets which were purchased, and the assets which were sold. So we don't have so many items which we record here. Leave just enough space, not a big one. And then from there, we have the other subheading for determining the cash flow from the financing activities. And actually, all the items which we record here, we get them from equity and basically the non-current liability section of the statement of financial position. All the items which we record here, we get them from the balance sheet, specifically at the equity and non-current liabilities. And then down here, we come and we record something known as the cash and cash equivalent. This is cash and cash equivalent, a balance, a brought down, and also we record the cash and cash equivalent, balance carried what? Balance carried down. Balance carried what? Balance carried down. That's the first thing you need to have anytime you come across this particular question for what? For cash flow. Anytime you come across this particular question for cash flow. And then having that now, I want we proceed and we look on how then do you get the low-hanging fruit. So there are the low-hanging fruits. Remember, we have said that these are the free marks. These are the marks basically you get without any working, without any what? Any working. So basically the first thing I advise my student to record is this: cash and cash equivalent at the start and also at the end of the year. So what do you mean by cash? Cash, basically, you can be able to record, this is cash in hand, cash at bank overdraft, and then cash equivalent. These are the short-term investments. The short-term what? Investments. So basically what we need to do is we go to our statement of financial position under the current assets. We check whether we have cash in hand, cash at bank, short-term investment, and then still we will go to where we have current liabilities. So under the current asset, can you tell me which item of cash and cash equivalent do we have there? Which item of cash and cash equivalent do we have under the current assets? So tell me which item of cash and cash equivalent we have there. Which item of cash and cash equivalent do we have? Do we have under the current assets? Type it in the chat box. Yes, I'm told the first one is basically cash. Is actually what? Cash. You also check, do we have bank balance? No, we don't have bank balance. Do we have any short-term investments? This is what you refer as the current what? Down. That is also very, very important. Very, very important. Take cash at the start from the statement of financial position for 2023, and I hope you can see that is a figure of 2250. And then from there, we go to where we have the current liabilities. We check, do we have a bank overdraft? So under the current liabilities, do we have a bank overdraft? Yes or no? Do we have a bank overdraft? Yes or no? Under the current liabilities. Do we have a bank overdraft? No. So but if we had a bank overdraft is basically money which is owed to the bank. We come and we raise it there. So therefore, the cash and cash, that is an amount of how much? That is an amount of 69. That is an amount of what? Of 69. Yes, someone can, someone to share that question, in the chat box. Someone to share that question in the chat box. Someone to share that question in the chat box, please. Someone to share that question. Someone to share that question in the chat box. Okay, it has already been shared, Janet, there. I hope you have seen it. Yes, so that is the first thing you record. And in most of the cases, what is important for you to note, what is marked in these particular questions are the entries. Are what? The entries. And basically, mostly this particular question for cash flows, how are they marked? This is how these particular questions are marked. So like you can see the marks are located here were 16. So mostly this particular question will be marked like this. Any 8 correct items here, you are given 2 marks. So mean that if you get 8 correct entries here, you get 16. Alternatively, if the question has so many entries, the question can be marked like this. Any 16 entries at 1 mark, and basically you get what? The 16 mark. So it depends with the number of entries. So if a question do not have so many entries, it can be like marked like that. If the question has so many entries, it will be marked like that. So therefore, what is important here is not by the end of the day to do so many workings here. What is important when preparing a statement of cash flow are the correct entries you make here. Are the correct entries you make what? In the statement of cash flow. For example, those 2 correct entries, those 2 entries, they are correct. Those are already 2 ticks. Yes, after doing that, then we come back here to where we compute the statement of, or actually we compute the cash flows from operating activities. And remember in this case, I've said here, we are preparing this particular statement of cash flows using the indirect method. So under the indirect method, we compute this particular cash flows by starting here, or here we start with the profit before what? Before tax. When computing this, it's before tax. Where do we get the profit from before tax? We get this from the income statement. Can we go to the income statement? You give me the profit before tax. How much is the profit before tax from the income statement? How much is the profit before tax from the income statement? So in our case, it is referred as net profit before tax. Net profit before tax. Can you see that one? Net tax? Yes. So the net profit before tax is basically an amount of 450. But if you can be able to recall, we said in computing this particular cash flow from operation, we should start with the profit before interest and tax. In other terms, what is known as the operating profit. But if you check, in our case, we don't have that operating profit. So therefore, what we say is that to this particular profit here, the first adjustment which we make, or the first adjustment to this profit, is basically to add back finance cost, the finance cost, which is also known as the interest expense. The interest expense. And actually, this interest expense is always above that profit. It is always above that profit. So can you see that figure of the interest expense? Yes, the interest expense is the same. That is an amount of what? 3450. And actually now that will give us the profit before interest and tax. And then from there we say to this particular profit, we need to make a number of adjustments. The first adjustment we make to this profit is basically to adjust it with the non-cash items. We say for you to be able to remember the non-cash item to be adjusted to this profit, just remember that acronym. The acronym is dial G. Dial G. So this stands for what? This stands for depreciation. This stands for depreciation on profit. This one stands for impairment loss. Impairment loss on goodwill. Impairment loss on goodwill. A stands for amortization. Amortization of intangible assets. Amortization of intangible assets. Then this one stands for loss on disposal. Loss on disposal. So the loss on disposal is basically whereby the company disposed or sold some assets during the current year, and basically the asset was sold at a loss. They were sold at what? At a loss. And this one is basically stands for gain on disposal. This one stands for gain on what? On disposal. So therefore, what we need to do, we need to go to the additional information. But I think even before you go to the additional information, because most of these items will be given in the additional information, on the field, there are a number of items we need to adjust to this. We need to adjust. So can we go back to the statement of profit or loss? Whereby we are given other incomes, specific other incomes. So where we are given with the interest income received. Now, is that an income? That is the first thing you need to ask to determine here is the cash flow, the cash generating activities. Now, an interest received, interest as a result of that. So therefore, what you do, because that interest has already been included here, you come here and you erase it. So first of all, we can skip all these items, and then we take the interest which was received, interest income which was received, interest income which was received, which has already been added in this profit. So the reason why we are raising this is because this is not an income from operation. So this is an income generated by the company from what? Investing. So you raise it from that profit, and then you come and include it here. So that is the interest income which was received. And remember, this is money which was received. So when recording it here, you record it as a positive. So why are you recording it there as a positive? It is because it is cash which was received, is an inflow. But here we are recording it as a negative. Why? Because we want to eliminate it here from this profit. It is included there, but it's not income from operating activity. So you less it here, and then you bring it there. That is the first item. Then still under the other income, we have the gain on sale of investment. So the gain on the sale of investment. So anytime the company sells an asset, be it an item of PPE, and that item is sold at a gain, so that gain is usually accounted for as an income, but basically we say that is a non-cash item. That is a non-cash item. So take into account it is included there. What do? Place it down there. Then also below that, the gain on the sale of investment, we have the loss on sale. We have this. So the loss, basically this 450. You can see the loss in arriving at this particular profit, it has been deducted. It was accounted for as an expense. So, and because this is a non-cash item, what we need to do, we need to add it back. Actually, these non-cash items, basically which we have here, depreciation, impairment loss, amortization, and the loss on disposal, because in arriving at this profit, they had been deducted, what you do, you add them back. But now this gain, you do what? You less it. That's basically what you need to remember. Yes. So you can see that all these are 3 months. All these are 3 months. This is basically what we refer to as low-hanging fruits. These are basically marks which you're able to get in this particular question without any struggle. Without any what? A struggle. You can see so far we have not done any working, but we have so many entries here. Yes. Now, having said, I think we need to go to the additional information because we don't have anything else we can be able to pick from the statement of profit or loss. Let's go to the income statement. Not to the income statement, in the additional information. In the additional information number 1, we are told Precious Limited purchased investment worth 11.7 million during the current year. So this company purchased investment. So if a company purchased investment, remember is a form of an asset. And that's why if we go back to our statement of financial position, specifically where we have the non-current asset, you'll be able to see we have the property, plant, and equipment. We have accumulated depreciation. Below that, we have investment. So we have said those particular activities in assets, they are what? Investing activities. So that purchase of investment, you come and you record it here. Purchase of what? Purchase of investment. Purchase of investment. So the investment which were purchased were 11.7. And I hope you can be able to remember in all the figures we are given in the income statement of financial position, the last 3 zeros are omitted. So anytime you're taking a figure from the additional information, you must do the same, omit the last 3 zeros. Then you also need to remember our rule here. When preparing the statement of cash flows, we have said this rule is very, very important. This rule is very, very important that any amount which is a cash inflow, we record it here as a positive. Any amount which is a cash outflow, we record it in our statement of cash flow as what? As a negative. So now who can tell us this particular amount here? Once the company purchased an investment, is that an inflow? That particular amount there, is it an inflow or outflow? The company purchased an asset. Is that an inflow or basically outflow? Inflow or outflow? Who can tell us? Inflow or outflow? Yes, automatically this one is outflow. This one is what? Is outflow. So take into account is an outflow. We record it here as a negative. Don't forget, if you record it here as a positive figure, it is wrong because the person is marking will only give you mark if it is recorded as an outflow. We are done with that. Let's move to note number 2. We are told the company sold a new investment that had cost 13.5 for 15.3 million. So we have sale of investment. So remember what we consider here is asset which were acquired, asset which was sold. So in that case, we can say there was sale of investment. There was sale of investment. And basically, once the company sells an asset, what do we consider here? What we consider here is the proceeds. When talk about the proceeds, this is the money you receive after selling an asset. If you sell an asset, how much cash do you receive? So in that case, we are told in note 2, that investment had a cost of 13.5. It was sold for 15.3. How much cash was received in that case? Is it 13.5? Is it 15.3? How much cash was received? You can tell us here. The cash inflow, the sales proceeds, that's basically what we consider here. Yes, I'm told by Evans that the cash received here is 15.3. 15.3 units. Yes, that is very much correct. 15.3. And then 15.3, this is an inflow. When you sell an asset, you receive money. You sell an asset, you receive what? You receive money. You receive money. Yes. So basically, that is it. That's what we need to recognize here. So we are done with that. Let's move to note number 3. We are told during the year, a new machinery worth 18 million was acquired. Was what? Acquired. That is also another free entry here. So the company acquired a machine. So once the company acquired a machine, that is still an investing activity. So we say there was acquisition of what? Of a machine. there was acquisition of a machine. You can see the number of entries we have in our statement of cash flows, yet we have not done any working. Have we done any working, Kelvin, here? Have we done any working, Eunice? Have we done any working, Evans? We have not done it. And you can see the number of entries which we have. So because I've said what is marked in these particular questions are these entries. That's fine. This is basically what we refer to as the low-hanging fruits. This is basically marks you get without a lot of struggle. So and then you are told in the same point number 3, sentence 2, some item of property, plant and equipment at a cost of 1.5 and accumulated depreciation of 300,000 were disposed for 750. So many free marks here. So we have disposal. Disposal, remember, is the same with the sale. Is the same with the sale of an item of PPE. What do we consider here? What we consider here is the proceeds. So that item of PPE which was disposed, we are told it was disposed for how much? Can you see the sales proceeds here? So that item which was disposed, was it disposed at 1.5, 300 or 750,000? It was disposed for how much? What is the sales proceeds? That is basically what we consider here. Yes, the amount which we consider here is 750. 750. The sales what? The sales proceeds. So basically we are done with that point. Let's move to point number 3. Point number 4. We are told included in the operating expenses for the year which ended 31st of March 2024 is depreciation charged, and the depreciation charge for the year which amounted to 5,550,000. So in our case, we come back here. We are given this depreciation, which is 5,550,000. That is another free entry. So, and we said that this is a non-cash item. It was deducted in this profit. We add it back. That's why we say this part, these 4 items there, we add them to the profit. So we are done with that. So we move to point number 5. We are told the company issued bonds worth 15 million at a face value in exchange of a plant asset on 31st of March 2024 and repaid bonds worth 7.5 at the face value, at the face what value. Now in that case, we are given 2 transactions in 1.1. We are told the company issued bonds. Bonds are basically the same with the debentures. So bonds are the same with the debentures. So mean that if you go to the balance sheet, to the statement of financial position and the non-current liabilities, you should be able to see bonds there. And I hope you can see that in our statement of financial position and the non-current liabilities, we have both. Bonds are basically the same with debentures. We are told that there were some bonds which had a value of 15 million, which were issued in exchange of a plant. Let me first of all ask, is this, or do we have any movement of cash there? The moment the company issued bonds in exchange of an asset, do we have any inflow or outflow to the company? Do we have money flowing in or money flowing out? You issue bonds, you receive an asset. You issue bonds, you receive an asset. Is there any movement of cash there? There is no movement of cash. So therefore, what is important to note is that when preparing a statement of cash flow, actually from our definition, I said, it is prepared to show the sources of cash and the application of that cash. How was the cash generated by the company utilized? So therefore, in preparing a statement of cash flow, any transaction which does not involve movement of cash, any transaction which does not give rise to cash outflow or cash inflow, we don't consider it here. Sasa, yes, like that transaction will not be considered here. It's a non-cash item. But also on the same point, you are told the company repaid bonds. So when talk about repaying bonds, you see bonds are issued by the company for the company to borrow money. So the company usually will have agreed with those who will buy bonds that they will be given back their money after a number of years. For example, the company can issue bonds having a life of 5 years. So meaning that the holders of the bond will be given back their money. In other terms, the company will pay back those particular bonds at the end of the 5th year. So once the company repay bonds, that is a cash outflow. And where do we consider that? We consider that here. That's why we said all the items which you record here, we get them from equity, non-current liabilities. We know both are part of the non-current liabilities. So here we will come and we say there was a repayment of bonds. There was a repayment of bonds, basically which had a value of 7.5. And this is cash outflow. The moment the company repay back the bonds, which had been issued, that involve cash outflow. So we are done with that point. So let's move to point number 6. And you're told the company issued 2.25 million ordinary shares of shillings 10 per, basically per value. So where do we consider this? This one is considered here. And basically, can you go to where we have, because that basically affected the share capital. Let's go to where we have share capital, share capital, share capital. And basically, in that case, you can see the share capital increased from, because remember in our case, we are given a statement of financial position for 2023. I've said these are opening balances. And 2024, basically, which you have said are closing balances. So you can see the ordinary share capital at the start was 47 to 50. And then at the end of the year, the share capital increased. So the reason why we have an increase in share capital is because the company issued shares. So who can tell us how much is the increase here? The increase is how much? The increase, that increase in share capital, yes, I'm told by Evans is 500. So basically, as per point number 6, we are told this increase was due to issue of how many shares? The company issued 2250 ordinary shares, each share having a value of 10. So if we multiply this, the value of each share with this one, you'll see that will automatically give us that amount. So when the company issues shares, that one is considered here is a financing activity. The company issue a share to do what? To raise finances. So we say there was issue of ordinary shares. So how much amount was received? 22.5. So the amount received by the company is a cash what? Inflow. So we consider that here. We consider that here. Yes, we consider that here. So then after that, we move to the last point. Number 7, the company paid cash dividends of 1.2. This was a very, very simple question. Almost everything is provided. So once the company paid dividends, those dividends paid are recorded here. So we say cash dividends paid. Cash dividends which were paid how much? 1.2. So the moment the company paid dividends, that is a cash outflow. That is a cash outflow recorded here as a negative. Recorded there as what? As a negative. Are we done with the notes? Yes. Can you see the number of entries we have here? Even if, for example, the question was marked like this, because this one automatically, you can see it has so many entries. So automatically, for every 16 ticks, 16 correct entries, you get a mark for each. And basically, by the end of the day, you get how many marks? 16. Can you see the number of entries we have? Basically, we have not done any working, but you can see the number of entries we have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. If you decide to read that question like that, you'll be having all the marks. You'll be having all the marks. And basically, that's a question which you should be able to do within not even more than 30 minutes. Because the other thing, maybe for those who are doing the CASNEB exam for the first time, so you'll come across a question with 5 marks. 5 questions. You're given 3 hours. So if you take 3 hours times 60, that basically comes to a total of 180 minutes. 180 minutes. So this basically to handle how many questions? 5. So if you take 180, you divide with 5, basically this will give you 36. So it basically means that this question should not take more than 36 minutes. More than 36 minutes. That's why it's basically important for you to know the approach to use, because if by the end of the day you start with doing the workings and then later on you prepare this, you'll spend a lot of time. So you may see that you're spending one full hour to do one question. And basically, remember, you have 4 other questions. So that's why it's very, very important for you to be able to know the approach to use in doing these questions in an exam. Other than knowing the approach, number 2, you should also be able to know how to harvest the low-hanging fruits, how to get the free marks. The free what? The free marks. Now, after doing that, there are other free marks here you should always get. You should get down here. And basically, that is in relation to the changes in working capital. These are also free marks. Changes in working capital. Now, here, remember we consider majorly 3 items. 3 items. And for you to be able to remember the items we consider here, just recall that acronym. Just recall that word. Just recall this acronym here. RIP, receivables, inventory, and what? And payables. That is basically what we do, what we consider here. So Juma is asking, so workings don't carry any single mark. No, Juma, workings do not carry any single mark. In fact, having marked these papers for a number of sittings, I know those who mark, the moment you start with the workings, you just put cross line like that. So if you, for example, you have the first page and the second one is working, just a cross line like that. So the person who is marking this question for you will be checking, did you prepare the statement of cash flow? And now, if you prepared this, he will come and check these correct entries. So that's where the marks are. Never start with workings. Those workings, by the end of the day, they do not earn you any marks. They just consume a lot of your time. And I've said any working you are doing here, do it per need basis. You are computing an item to be posted here. Don't compute something which is not required to be posted here. Do all the workings per need what basis. Because knowing that approach, Juma, is very, very important. It will save you a lot. It will save you a lot. Yes. Let's come back here now. Let's come back here. I want us to still do another question like this. So here we consider 3 items: receivable, inventory, and payables. So receivables, inventory, and payables. But basically I've said, remember this acronym. Not less in piece, but this one stands for the receivables, inventory, and what? And payables. Now, what we need to do basically here is to do what? Is to determine whether there was an increase or decrease as far as these 3 items are concerned. Now, to make it very simple, here there is a formula I give my students. So here we take this. I'll be able to explain what you mean by that. O minus C. And then here C minus O. Yes. So just remember that. O minus C, O minus C, C minus O. So what is this? This is opening balance minus closing. Opening balance minus closing. Closing balance minus opening. So you apply that formula. Whatever you get by applying that formula, if it is a negative, you record it as a negative. Whatever you get by applying that formula, if it is a positive, record it as what? As a positive. Yes. So we start with we go to where we have our statement of financial position under the current asset. We know inventory and receivables is part of the current asset. So can we start with the first item? And that is the inventory. So we will take the opening, which is 16.5 minus the closing. Opening minus closing. 16.5, which is the opening, minus closing, which is 21.6. 21.6. What do we get? What are we getting here, Eunice? Yes, we are getting negative 51. So recorded, that is what? An outflow. And basically that is inventory. That is what? Inventory. That is the inventory. That is the inventory. And then from there, we do the same. We do the same for receivables. Receivables, we do the same. Opening minus closing, 82.50 minus 70.50. So we get positive what? Positive 21. Positive 21. So we have that. But now, before we move to receivables, to payables, I hope you can also be able to see under the current asset. Below cash, can you see we have prepayments? Can you see we have prepayments? Yes. Now, prepayment is basically part of receivables. It's part of what? Receivables. So in case under the current asset, in most of the cases will be given the account receivables, and other receivables. If you're not given other receivables, the examiner will give you prepayments. Other receivables can also be known as what? Prepayments. So what we consider here is the trade or the account receivables and other receivables. So in case you're given prepayment, also you have to consider that here. Are we together? Yes, because this is one of the items most of the students will not consider here. So prepayment, basically I've said is the same with other receivables. We are going to use the same formula. Opening minus closing, because the same with the receivables. So can you do that? Opening minus closing. Opening minus closing, what are you getting? That is giving us negative, Negative 600, Negative 600. Yes, I'm waiting for the answer. I'm not getting the answer fair. Please give me the answer. I'm saying under the current asset we have, below cash we have prepayments. Below cash, we have prepayments. We have prepayments. We have prepayment. It is positive, eh? Yeah, it is positive. It is positive. It is positive. It is positive. Okay. So then we got where we have current liabilities. We consider payables. Current liabilities, payables. For payables, we use this formula: closing minus opening. Closing minus opening. Closing, which is 75, minus opening, 64.50. 64.50. So which is giving us what? Which is giving us 10.50. Are you getting 10.50? I'm not getting the answers here. I'm not getting answers. Juma, give me the answers. Eunice, Paul, give me the answers here. Give me the answers. Give me the answers. Hussein, Felix, I'm waiting for the answers. Zipporah, give Morimu the answers here. Give me the Morimu the answers. Okay, yes, that's basically what we have. It is also important here also under the current liabilities, just like what I've said under the current assets, under the current liabilities, you also need to check whether you are given something like accrued expenses or maybe accruals. So what else do we have there? We have, yes, there is something also we are going to consider here, and that is accrued liabilities. Now, the accrued liabilities, that one is the same with the accruals. So, yes, other than considering the payables, you also consider other payables. Other payables can be accruals or maybe accrued expenses. So we also consider that here, and that is the accrued liabilities. Accrued liabilities. Accrued liabilities, we use the same formula here, this one, closing minus opening. Closing minus opening, closing 18 minus 13.50, which will give us what? 450. 450, is that what you're getting? 450? Yes, 450, which is basically a positive. That's what we consider there. Then I think we're almost done. Two other items which are also important here. Number one is the tax paid. The tax paid, and number two, the interest or the finance cost, which was paid. Now, for the tax which was paid, this one we need to do some working. So which is not complex, because what we consider are two items. One, if we go to the income statement, we have the income tax expense for the current year, which is 1050. And then if we go to where we have current liabilities, we have tax payable. So how do we compute the tax which was paid? To compute the tax which was paid during the current year, I want you to be very keen. We take the accrued tax at the start. Under the current liabilities in the balance sheet, how much tax was payable at the start of the year? The tax payable at the start of the year was how much? Was 750. So this is the tax the company was supposed to pay at the start. And then to that, we add the tax which was payable during the current year from the income statement. From the income statement, our company was supposed to pay a tax of 1050. So this is the total tax the company was supposed to pay during this year. And then less the tax which are not being paid at the end. The tax which are not being paid at the end is what we have in the balance sheet under the current liabilities, and the tax which are not being paid was 450. It basically means that the difference here is the tax which was paid. So this will give us tax paid of how much? I've taken the tax the company was supposed to pay at the start, the tax the company was supposed to pay during the current year, and then I've deducted what are not being paid at the start. And basically, then for the interest which was paid, this one I think is quite straightforward. You consider two items: the interest expense in the income statement, which was these liabilities. You check, do we have any accrued interest? In case we have accrued interest under the current liabilities, you use the same approach we have used for tax there. You should take the accrued interest at the start plus the interest in the income statement, this one, minus the accrued interest at the end, which basically give us what? 34.50. That is basically the tax which was paid. Not the tax, rather, the interest which was paid. And in our case, we are done. That question, don't bother adding anything. The person who is marking your paper will be interested with these entries which we have here. he will be interested in these entries. So he will mark these entries. These what? These entries which are here. These entries which are here. These are the entries which will earn you the marks like that. Not even the workings. Not even the working. So that is basically what will be marked. And therefore, as you practice, can you try to use this particular approach here? This basically will save you. This will do what? Will save you in an exam. This will save you in what? In an exam. I want us to do another question. I want us to do another question for cash flow. Another question for cash flow. Another question for cash flow. For cash flow, we can pick. I want us to go to the question for August 2023. August 2023, August 2023, still from CPA foundation level, CPA foundation level. Yes, and maybe for those who are joining the class, our class here for the first time, who are not part of our students. So our block revision actually started today. This should be our first class for revision for financial accounting, and yes, financial accounting. So if you know of a colleague who is basically preparing for August 2025 exam, is not well prepared, you can basically talk to him or her to join us, to join our revision. Right now we have an early bird discount. Basically, if a person pay for our blocks, we are just charging as low as 1,500 per word per unit. So basically, this will help you in terms of accessing our revision for the next 4 weeks. So our revision classes will take place from today, which is basically is 20. Take place from today, which is basically is 21st of August. So basically, this will be a 4-week marathon for revision classes. So if you know someone who is preparing for this exam, the August exam, is not well prepared, or maybe he wants to prepare, so you can talk to him or her basically to join our revision classes. I've said we are charging 1,500 for all the units, but maybe for those who are doing BDA, Business Data Analytics, this is an exit paper in CPA. For that paper, we are charging 2,000. That is an early bird discount. It will expire tomorrow. So if you take the advantage of the discount, basically that will be better. So from tomorrow, you take the advantage of the discount, basically that will be better. So from tomorrow, the amount now will go up with 500. So that question has already been shared here by Evans. August 2023, which is question number 4. August 2023. Question number 4. So what are we told here? The question is, we are told the following information was extracted from the financial statements of 𝐵iashara Limited for the year which ended 30th of June 2023. 30th of June 2023. 30th of June 2023. So we are given the statement of financial positions here. That is the statement of profit or loss for the year which ended 30th of June 2023. And then we have the statement of financial position for 2023 and basically 2024. So in that case, we have said 2022, the figures given here are opening balances. 2023 are the closing what? The closing balances. The closing what? The closing balances. So we have basically that statement of financial position. We have the additional information, number 1, all the way to note number 5. So what are we required to do here? We are required to prepare the statement of cash flows for the year which ended 30th of June 2023 in accordance with IAS 7. Is the method to be used specified? No. But I've said if you come across a question for cash flow and you're given the income statement of financial position, always use the indirect method. So then from there, we're required to comment on how 𝐵iashara Limited has generated and used its cash and cash equivalent for the year. So you can only be able to comment on that after preparing the statement of work of cash flows. after preparing the statement of cash flow. So we have said never start with the workings, just go straight to what is required by the examiner. So the name of this company is 𝐉𝐎𝐻𝐿 Limited, and this is the statement of cash flows. The statement of cash flows, which is basically for the year, which ended 30th of June 2023, 30th of June 2023. 2023. So here we start by determining the cash flow from operating activities. Cash flow from operating activities. We need to have two columns here. And I hope you can also be able to see our figures there are given in thousands of shillings like this. Are given in thousands of shillings. Are given in thousands of shillings. Yes, so we have said we leave enough space here. Then we have the other subheading for computing the cash flow from investing activities. And I hope you can be able to recall investing activities. These are activities involving acquiring and disposing assets. And then we have the other subheading for determining the cash flow from the financing activities. Remember, I've said all the items which we record here, we get them from equity and current liability section. And then down here, we come and we record the cash and cash equivalents. Cash and cash equivalent at the start, and the cash and cash equivalents balance carried down. So that is the first thing you need to have there. That is the first thing you need to have. You need to have. So if you have that, I want us to now move together. We prepare this together. So do you have that format with you? If you have that format with you, I think we can move together. Do you have that format? Do you have that format with you? If yes, type that in the chat box. Yes. So we have said we always start by recording what? The cash and cash equivalent at the start and also at the end. So can we do that? We go to where we have the current assets. In the statement of financial position, determine how much was the cash and current assets. So I can see we have short-term investment. That is the first thing we need to consider here, short-term investment. The short-term investment at the start. Remember, 2023 is the current year. These are the closing balances. 2022, these are opening balances. That is very important. So the short-term investment at the start is 50/40. So below that, we have which is 25/80. And then we go to where we have current liabilities down there. We check, do we have a bank overdraft? Yes or no? Yes, I can see we have a bank overdraft. The bank overdraft at the start, which is 2022, is 39,240. And in this case, I've said a bank overdraft. We take it here as a negative. We take it here as what? As a negative, because this is money which is owed to the bank. We get the net amount. That will give us a net amount of what? We have 50/40 plus 25/80 minus the overdraft, 39,240. 39,240. What are you getting here? I'm getting negative 31,620. 620. Is that what you're getting? Yes. And that one is a negative. We do the same at the end of the year. So at the end of the year, we will take the short-term investment, which is basically 10 to 60. And then we take the cash in hand, which is basically 12. And then we less the overdraft, which is 14,340. 14,340, we get the net, and that is the cash and cash equivalent at the end. So 10 to 60 plus 12 minus 14,340, and that will give us negative what? Negative 28,810. Negative 28 what? 8. We already have two entries which are correct. Then we come back here and we start by recording a cash, that is not cash, rather the profit before what? The profit before tax. What is the profit before tax from the income statement? The profit before tax from the income statement, I hope you can see that, is the figure of 14,400. I hope you can see that. Then we make a number of adjustments to this profit. And the first adjustment we make to our profit, we said, is to add back the finance cost, or basically to add backward the interest. The interest. That is the first thing you need to remember, which is basically just above this. So, and I hope you can see that figure there, which is 25. Sasa, we add it back. Such that now we have what? We have the profit before interest and what? And tax. Then we have said to this, we need to, or we adjust that profit with the non-cash items. We just need to remember this acronym, the dial G. This stands for depreciation on property, plant, and equipment, PPE. This one stands for impairment loss. Impairment loss on goodwill. And based for amortization. Amortization of intangible asset. Amortization of intangible asset is the decrease in value of intangible assets. And then this is loss on disposal. Loss on disposal. And then this one is the gain on what? On disposal. So we have said these past four items. This one, we add them to the profit, but this one we do what? We less. So on the face of the income statement, do we have any of those items? On the face, like the other question. On the face of the income statement, we don't have any of these items, but I can see investment income. Can you see the investment income? Yes. Investment income, basically, this is an income generated by the company from investment. So it is already included here. What we will do, we will less it from that profit. Why are we listing it here? Is because it's not an income generated from operation. Generated from operation. So we less it here, then bring it here. And basically, therefore, what you need to note from the other question which you have done, interest income received is the same with the investment income. Investment income is the same with what? Interest received. That's that? Yes. So we bring that here. It's an amount of how much? 15. So then from there, we don't have anything on the face of the income statement. Can we go to the additional information? Let's go to the additional information. In the additional information about what we are told, the revaluation reserve relates to freehold land. So if you're given told revaluation reserve, these are components of equity. If you go to the balance sheet and the equity, you should be able to see that. But it's also important for you to note that if there was some asset, for example, which were revalued upward or downward, we don't consider that here because that is a non-cash item. So note number 2, we are told depreciation on plant and machinery amounted to 6.9. Amounting to 6.9 was charged to the statement of profit or loss. In that case, we are given depreciation of 69. And remember, when taking any figure from the additional information, remember to omit the last 3 zeros because you can see our figures are in thousands. So we add it to this profit. Number 3, part of the long-term investment was sold during the year at a profit of 960. Part of the investment was sold at a profit. We are only given the profit in this case. We are not given the sales profit. So what do we record here? 1, we will record that sale of investment. Sale of investment. But remember, I've said what we record here are the proceeds. So how much amount was received from the sale of this investment? Are we given that? No. But what we are given is this. We are told there was a profit. A profit is the same with a gain. A profit on sale is the same with a gain. So the profit on the sale is the same with a gain. So there was a gain in this case of how much? Over 960. So that gain, this one we less it from that profit. But even before we move to the other point, number 4, can we be able to know this investment which was sold? It was sold for an amount of how much? Can we go back to where we have non-current assets? Non-current assets. Non-current asset, how many assets do we have there? We have three. Freehold land, plant and machinery, investment. Automatically, because investment was sold, the value for investment reduced. Can you see that? The investment at the start had a value of 22.5, and then that reduced to 21.6. Can you give me the reduction? Give me that reduction in the value for the investment. And then I will be able to explain how do we compute the sales profit. How do we compute the sales profit? So the value for investment reduced with what? The value for the investment reduced with what? The value for investment reduced with what? The value for investment reduced with 900. It basically means that this investment which was sold had a value of 900. They had a value of 900. The company sold the investment having a value of 900. This is the value for the investment. But by the end of the day, we are told the company made a profit of 960. So that is the profit, made the profit of 960, made the profit of 960. So in this case, can we be able to know our investment was sold at how much? If you have an asset having a value of 2 million, and then you sell it to make a profit of 1 million, you sold that asset at an amount of how much? You have an asset having a value of 2 million, but you sold it, you made a profit of 1 million. So you sold that asset at an amount of how much? That asset was sold at how much? Very simple. If you have an asset having a value of 2 million, you sell it to make a profit of 1 million. Automatically, you sell it at 3 million. The same concept you're using here. So this investment was sold at its value, 900, plus the profit. So this one was sold at 18.60. So that is a cash in for because this money received from the sale of the investment. So let's go to note number 4. We are told during the year, the plant with a net book value of 4.5 was sold for 8,820,000, and then you're told it had an original cost of 18. So what we are interested with here is the amount which was received from the sale. Remember, anytime the company sell an asset, you consider here. We said there was a disposal. Disposal is the same with the sale of a plant. What do we consider here? We consider the proceeds. It was sold at how much? It was sold for 8,820,000. So that is the what? That is the proceeds. That is sales profit. Also, if you can be able to recall, we say that anytime the company sell an asset, you have to determine was the asset sold at a gain or at a loss. So we said if you can be able to remember, my student for FA, we said you need to prepare a disposal account, though it's not a must. Once the company sell an asset, for you to determine whether it was sold at a profit or at a loss, just take the sales proceeds. Just take the sales proceeds. The asset was sold at an amount of how much? You less the net book value, which is also known as the carrying amount. In that case, we know that item was sold at 8,820. I hope you can be able to see up there, minus its net book value. We are not given the net book value, but basically, yes, we are given the net book value actually. The net book value is given, which is 4.5. 4.5. So you can see automatically that asset was sold at a profit. Because we said by applying this formula, if you get a positive figure is a profit or a gain. If you get a negative figure is a loss. Is the loss. So how much is the profit here? The profit in other terms known as the gain. The profit or the gain is how much? 8,820 minus 45. Yes, we have a profit of 43.20. So this is a profit, or in other terms, is a gain on the sale. Is a profit or is a gain on the sale of a plant. Now, that should also be captured here because you can see the company sold 2 assets. There was what? There was gain on both. So that gain. So remember, this is a gain on sale of investment, and then we have gain on sale of plant. So the gain on sale of plant is 43.20. We also less it from our profit because in arriving at this profit, it was added, but it's a non-cash item. It's a non-cash item. So we are done with that point. Let's move to point number 5. We are told the following balances were extracted from the statement of changes in equity for the year which ended 30th of June 2023. So this is basically the change in the retained earnings. So we're given the retained earnings at the start, the profit after tax, the interim dividends which were paid, the final dividends which were proposed, and the balance. Now, from that information, what we are going to consider here is basically the interim dividends which were paid. If the company pays some dividends, and basically talk about the interim dividends, these are the dividends paid by the company in the middle of the financial year. If the year starts January, end in June, maybe the company in course of that year paid some dividends. That's basically what we consider here. So the dividends which were paid. That is basically 900. The dividends which were paid, the interim, but you can see we have other dividends which were proposed to be paid. So the proposed dividends were not yet paid. They were 27. But I think you have now to compute the final dividends which were paid. The final dividends which were paid. So how are we going to compute these final dividends which were paid? We are going to use the same concept which I've explained in the other question for computing the tax paid or for computing the interest paid. Now, if you go to where we have current liabilities, can you go to where we have current liabilities? Current liabilities. At the current liabilities, you'll be able to see proposed dividends at the start, at the end, in the balance sheet, at the current liabilities. So we are going to use the same concept we have used in the other question. In the other question. So yes, thank you for that. I'm told it is not that figure Morimo is speaking here. No, I hope maybe you're asking about this one. I hope you're asking about this one. Are you asking about this figure? Yeah, the gain? Yes, the gain should be a negative. And this one should be deducted from our profit. I hope you did the same for this. Any gain on the sale of assets has to be deducted from this. Because this one is already added here, but basically is a non-cash item. We do what? We less it. Sasa? Yes. Now let's come back here and we compute the final dividends which were paid. I'm saying we are going to use the same concept we have used in computing tax paid, interest paid. So what we do at the current liabilities, we will take the dividends which were proposed at the start, that is the year 2022, and they were 22.80. These are the proposed dividends the company was supposed to pay at the start. And then we add the proposed dividend for the current year, which we have in note number 5. The proposed dividend for the current year, they have a value of 27. So this will give us the total dividend the company was supposed to pay during the current year. And then we less the dividends which were not yet paid at the end. The dividends not yet paid at the end, you can see they have a value of 27. So can we be able to determine the dividends which were paid? Yes. So it will basically be this one. 22 what? 22.80. We record it here as a negative. So, and I think we are done with the notes. Having finished with the notes, then we come down here and we consider what? The changes in working capital. Never forget to get these 3 marks. Changes in working what? Capital. Because here we have said these are just 3 marks. These are just 3 what? 3 months. So here we just need to recall the acronym, that is RIP, not less in piece, but receivables, inventory, and payables. The receivables, inventory, and what? And payables. So how do we deal with these 3 items? We just need to determine whether there was an increase or decrease, and then we determine is that increase or decrease an inflow or outflow. So I've said just use this formula: opening minus closing, opening minus closing, and then this one closing minus opening. As simple as that. As simple as that. As simple as that. Juma, I've said the computation of this, we are using the same concept. If you have understood how we have computed the tax paid in the previous question, we are using the same concept. You see, the proposed dividends are the dividends, the proposed dividend are the current liabilities. Those are the dividends which were not paid at the start and also at the end. The proposed dividends we have in note number 5 are the dividends the company was supposed to pay during the current year. So how do you compute the actual dividends which were paid during the current year? You take the dividends the company was supposed to pay at the start, add what the company was supposed to pay during the current year, and then compare that with the dividends not yet paid at the end. Automatically, the difference represents the dividends which were paid during the current year. And that is basically the same concept used in the computation of tax, in the computation of interest. That's yes, the same concept. If you understand that, that will save you for 3 items: the tax paid, interest paid, and the proposed dividend. Yes. So let's deal with these 3 items. We are going to go to where we have the statement of financial position, and we start by picking receivables. So not receivable, rather, let's start with the inventory. We take opening minus closing. The opening is the figure we have in the statement of financial position for 2022. That is 200 minus closing 300. And I'm getting negative 81. Negative 81. I hope that is what you're getting. That is for inventory, not receivables. Inventory here. Yes, so I'll do the same. We need to do the same for receivables. For receivables, we take the opening, which is 46,800 minus closing, which is 36,840. What are you getting? I'm given by Evans 9960, basically, which is a positive, is a cash inflow. Then we have said you also need to check whether you have other receivables or prepayment. Do we have other receivables or prepayment? No. We go down there where we have the current liabilities. Under the current liabilities, we only consider one item: account payable. Account payable, we use this formula: closing minus opening. Closing minus opening. So the closing is 35,100 minus opening, which is 31,500. And basically that will give us what? That will give us 36, which is a positive. Which is what? A positive, which is a positive. And then from there, we proceed and determine 2 other items. One, we less the tax paid, and then we also less the interest or the finance costs paid. So we can start with the tax. Tax, we are using the same concept we have used in the other question. So we go to the income statement, how much is the tax for the current year, and the statement of financial position at the current liabilities. So can you first of all go to where we have current liabilities in our statement of financial position, and we consider whether we have tax. Yes, and we have tax. The tax which was not yet paid at the start is 36. And then to this, we add the tax in the income statement. I hope you can see the tax in the income statement, 54. And then we minus, just the way we have computed the dividends which were paid, using the same concept, minus the tax not yet paid at the end, which is 4920. So the tax in the income statement is 54. Tax at the start is this one. Yes, so that will give us tax paid of how much? Yes, 48. So we do the same for interest. For interest, you just need to go to where we have current liabilities. You check, do we have any accrued interest under the current liabilities? No. If that is the case, it basically means that the interest paid is what we have in the income statement here. But if we had any accrued interest under the current liabilities, we use the same concept. Take accrued interest at the start plus the interest or the finance cost from the income statement minus the accrued interest at the end, which will give us what? That amount. We are done there. So don't even bother yourself adding anything. Let's come here. I think here majorly we have dealt with most of the items because we are given the asset which were acquired, the asset which were purchased. Can we go to the equity and non-current liabilities in our statement of financial position? At the equity, first of all, I can see share capital. The share capital at the start was 90,000. It increased all the way to 108. What causes the share capital to increase? The share capital increases because our company issued shares. So we will come here and we say that there were shares which were issued. The shares which were issued will automatically be equal to the increase. 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 How much is the increase here? The increase is 18,000. So the shares which were issued by our company, they had a value of 18,000. 18,000, which is a cash inflow. Below that, what do we have? We have share premium. Share premium, did it increase? Yes. What causes the share premium to increase? The share premium basically increases because these shares which were issued, they were issued at a premium. That increase in the share premium represents the money which was received by the company in form of share premium. So you will also come here and you say there was increase in what? In share premium. And basically in this case, the share premium increased with how much? The share premium increased with 45. That also represents money which was received by the company, but in form of what? In form of premium. In form of premium. In form of premium. We are done with that. So below that we have revaluation reserve. Do we consider that here? No. Revaluation reserve, this changes as a result of revaluation of assets. Once the company revalue assets, either upward or downwards, that is a non-cash item. We don't consider that here. Below that, the retained earnings, mostly that is used in the computation of dividends which were paid, but I think you already have that. Then we go to where we have 10% loan. 10% loan at the start, 32. At the end, that loan reduced. What causes a reduction in the value for the loan? What will make the loan to reduce from 34 million to 25 million? What causes the loan to reduce? What causes the loan to reduce? Who can tell us here? What causes the loan to reduce? The loan will reduce because of repayment. The loan reduces because of repayment. So we come here and we say there was repayment. There was repayment of 10% loan. There was a repayment of 10% what? Loan. So how much was the repayment? Which is basically equal to the decrease. Which is equal to the decrease. Which is equal to the decrease. Is it 9? Is it 9,000? Is it 9,000? Yes. And automatically, the moment the company repays a loan, that involves what? Cash outflow. So if you have taken a loan from the bank, you repay back that loan. That involves cash what? Outflow. That involves cash outflow. That question you debate at that point. Don't even bother yourself adding the totals here. Don't. That is pure wastage of time. The person who is marking your paper will come and check these entries. Will come and check these what? These entries. These entries. These entries. These are the entries basically which will earn you marks. These are the entries which will earn you what? Will earn you marks. And I hope you can see in our case, have we done any working here? Have we done any working? No. You can see all the workings which we are doing. We are doing them inside the bracket here. That will save you a lot of time. Will save you a lot of time. By using this particular approach, number one, I've said you'll be able to finish the question within the time you have, because I've said for you to handle this question, never make a mistake of taking more than 40 minutes. Maybe these questions computation, you can give yourself 40 minutes, because most will come across a theory question. Maybe the time you are taking to do a theory question, maybe you can just reduce it, maybe like to 20 minutes, such that this computation don't take more than 40 minutes. If you take more than 40 minutes, then that is a disaster. That is what? A disaster, because you'll not be having time to handle the other questions. So just pick those low-hanging fruits, those 3 marks, which basically you can be able to get without a lot of struggle, without so many workings. And actually, you can see this question, even if, for example, this is how the question was marked. Any 14 ticks at 1, you will see we already have all the 14 marks. All the 14 what? Marks. Because even if you count the number of ticks, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So we already have all the marks with us. Yes. So that approach, which I've showed you, very, very important. So as you practice, so can you use that approach? Make use of that particular word approach. Basically, this will help you in terms of passing any question for cash flow. The other thing you also need to understand is where do you get 3 marks? Or basically what in other terms we refer to as low-hanging fruits. I've said there are those marks which are free. Like here, changes in working capital. Make sure you get those marks. Probably you can be able to remember it, and these formulas I've given there. Opening minus closing. Opening minus closing. Payable, closing minus opening. Then here you can be able to remember this acronym, dial G. Then here you also need to remember that the items we consider here come from equity and current what? Liability. So if you're able to do that, these are questions. Once you come across this question, be assured you'll be able to pass. And basically, like for those who are doing a CPA foundation level, so I'm expecting that this is one of the questions you're likely to come across. This is one of the questions I'm expecting it will be examined. It will be what? Examined. If you check last teaching, there was no question on this. So can you do a lot of practice? Can you do a lot of practice? A lot of what? A practice as far as that is concerned. And then there was that other part, part B, comment on how Biashara Limited has generated and used its cash from cash and cash equivalent for the year. Now, basically, for you to be able to do to make that comment, you have to get these net cash flows. For example, you get the net cash flows from operating, the net cash flow from investing, and then the net cash flow from what? Financing. You must get those particular net amount. So once you get those net amount, then you need to make a general comment. If, for example, here you get a positive figure, here you get a negative figure, and here you get maybe also a positive figure, the first thing you say is that this company generated cash, one, from operating activities because we have a positive there, and also from investing, from financing activities because we have a positive amount there. And then you say, much of the cash generated by the company was spent or was utilized by the investing activities because here we have what? We have a negative. We have what? A negative. Other than making that comment that the company generated cash through through operating and financing activities, and the company spent cash through investing activities, you can then be more specific and you say that much of the money which was spent by the company, or maybe much of the money which was generated by the company from investing, from financing activities, it was generated from the issue of shares, because you can see here the company was able to raise a lot of money from the issue of shares. And here you can also be able to say that the company generated a lot of cash from investing activities by selling assets. By selling what? By selling assets. That is the comment. That is basically what you are expected to comment on. First of all, you must get the net cash flows from the three activities, and then make a general comment on which activities generated cash, which activities utilized the cash, and then you can also be more specific. You can be more what? More specific. More what? Specific. But what I want you to understand is basically how to handle this question for cash flows, particularly in what? In an exam. In an exam, because majority of the students basically understand how to prepare statement for cash flow, but basically they lack that particular knowledge of doing these particular questions in an exam. Because remember, you don't have all the time with you. You have just 40 minutes, less than 40 minutes to do what? To handle this question. You must be having a strategy on how to do the question within 40 minutes, and also how to get those 3 marks. That is very, very important. Very, very what? Important. Yes, so I'm told in this case, in case someone leaves a big space in between the 3 headings, we let it be, no, basically no, that will not have any problem. But basically by then, by the end of the day, once you do a lot of practice, you should be able to know the space to leave here. So once you do a number of questions, you'll be able to see the space you need to leave here. Because I don't think you should leave more than half a page. More than half a page. More than half a page. Yes, more than half a page. Or maybe a 3/4, more than 3/4 of the page. Because this basically where we have so many items, as you can see in the 2 questions we have done. Yes. So what I want you to do, I want you to pick other questions, maybe from the past papers. Those who are doing FR, we have so many questions on this from your papers. Those who are doing FA, foundation level, so many questions on this. Also, those maybe who are doing AFR, this is also a knowledge you need to have. Even if now the question for AFR, they have additional concept. The aspect of acquisition of subsidiary, disposal of what? Of subsidiary and so on. But this knowledge is basically important to all. The shortcut, how to get those row hanging what? Row hanging, or those basically those particular free marks. Yes. So basically for today, I want us we stop at that particular point. I want us we stop at that particular point. We continue from there in our next class. We will basically be inviting you for free sessions, because I know some of the topics, like in a PAL, in a FA, some topics may be the same, like ratios. Ratios are in FA, ratios are in a PAL, ratios are in the BDA, those who are doing BDA. So basically once maybe Marimo is revising a common area, I will basically be inviting you to attend these sessions. So equally remember, I've said that we started, actually our blogs started, our revision started today. If you know someone who is preparing for the August 2025 exams, and he needs some revision, you can talk to him or her basically to join us. I've said currently we have an 𝐅𝐻𝐵 discount which will be expiring tomorrow. We are charging 1,500 for all units for CPA, CFA, and also ATD. But those who are doing BDA, we have an 𝐅𝐻𝐵 discount of 2,000. So that discount, that 𝐅𝐻𝐵 discount will be expiring tomorrow. So maybe you can talk to your colleagues and basically join our ongoing revision classes. So let's stop at that point for today. See you tomorrow as we continue with our revision. And that is for those who are doing FR. We have a class tomorrow. What we are paid on a Friday. What we are BDA, I think we have a class after this. Those who are doing AFR, see you tomorrow. So have a good night. Do you have the question with you? If yes, please confirm. Please confirm, please confirm. I can see we have 1 hour, 20 minutes. We must finish this particular question here. We must finish that question. Okay, so what are we told? What are we told? That is the question number 2. So the question is, 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in Paper Limited, another public limited entity, on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐿𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐿𝐿 Limited, together with another entity, entered into a joint arrangement to jointly control 𝐶𝑠𝑠 Limited, a public limited entity, public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of 𝐶𝑠𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for 3 companies, 𝐿𝐿, Paper, and 𝐶𝑠𝑠. We have the statement of financial position for the 3 companies, that is 𝐿𝐿, Paper, and 𝐶𝑠𝑠. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure, that's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐿𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called 𝐻𝐻, a public limited company on 1st April 2024. So the company which is called 𝐿𝐿 Limited, this company acquired 80% equity shareholding in a company which is called 𝐻𝐻 Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐿𝐿 is the parent and then 𝐻𝐻 is the subsidiary. You can see also we given the date of acquisition. Then from there, once we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐿𝐿 Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐶𝐶𝑠 Limited, a public limited entity. Effectively, 𝐿𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝐶𝑠 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝐶𝑠 Limited. 𝐶𝐶𝑠 Limited, on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one would be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of a financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐿𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of 𝐻𝐻 Limited, remember 𝐻𝐻 now is the subsidiary. 𝐻𝐻 Limited net asset approximated their carrying amount, with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐶𝐶𝑠. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company devalue the asset, the subsidiary company does not account for that devaluation. As a result of that, when preparing the group account, we talked about two key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by paper limited. So we need to make two adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of paper limited net asset approximated the carrying amount, with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by paper. Did the paper limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There's a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what? Year. We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here. 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here, we had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation under charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation under charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation under charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the to the cost of sales? No. No. So in this case, we will add this depreciation under charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation under charge. Let's move to point number 2, where we are told 𝐓𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, use Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what? Method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiaries are fake sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and the balance payable was still outstanding. And the balance payable was still what? Outstanding. Now in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us first of all we deal with we compute the amount of unreleased profit, amount of unreleased profit, amount of unreleased profit. So unrealized profit on inventory. On inventory. Remember, unrealized profit we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to Lock, but basically some of the goods remained in the inventory of Lock. They were not yet sold to third parties. We need to compute the unrealized profit, and this unreleased profit is always by the selling company. The selling company is this one. So this is unreleased profit by Paper. By Paper. So how do we compute this unreleased profit? We take the unsold goods times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unrealized profit. Basically, by applying this formula here, we will take the unsold goods, and in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Lock. The unsold goods would be half of the goods which were sold by Paper to Lock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction. As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1 over 5. So this one will be the unreleased profit here. So it will be half to 50. And basically, this unreleased profit number 1, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we let's start from the group revenue. Number 2, retained earnings of the selling company. The selling company is Paper. That one will be deducted from the retained earnings of Paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. To the group cost of sales. Those are the 3 adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here would be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay Paper was 500 million. So this amount is the one which amount to, or which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically reveals that both goodwill on acquisition and on paper limited and the interest in CISA were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that such that if there is something you need to apportion on time basis, or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition, because there is something we will compute there. Let's first of all, we compute the goodwill on acquisition of this company here. Remember, you said we only compute the goodwill on acquisition of the subsidiary, and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is paper limited. And as per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent. Purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was intuition. And I hope you can be able to recall, we say that this one do not have any special treatment. That amount we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the state, you'll be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that point number, para cash payment of 24 and on 1st April 2024, and a further consideration of that 31 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and lock limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take that 31 and base to the present